All right, guys. Now let us start with chapter number 3. The name of the chapter is Risk Assessment and Internal Controls. Okay, and as you can see on the screen, guys, we have a lot of topics to cover here in this particular chapter. I'm just giving you an overview first. We are going to discuss about the basics of audit risk, what is risk of material misstatement, some assertions. So all these are basic topics, and then we are going to study one standard, a very important one from the 300 series, which is SA 315. And again, a continuation, an extension, let's say, of this standard. We are going to learn a lot of topics with respect to internal controls. Okay, after that we have two more standards from 300 series, which is on materiality, and basically how the auditor is going to assess to the how the auditor is going to respond to the assessed risk, the risk which he has identified as a part of 315. And finally, a small topic on audit in automated environment. Now, this automated environment used to be a separate chapter altogether in your old course, but now they have incorporated this as a part of chapter number 3 itself. Okay, so it's a big one, but yes, I am sure that you will have a good understanding towards the end. Okay, so let's begin, guys. The name of the chapter is Risk Assessment and Internal Controls, right? So first thing is we have to understand risk, the word risk. Okay, risk assessment, we'll first understand the two risk. Basically, one is audit risk and the second one is risk of material misstatement. Okay, so what is audit risk, guys? You have to understand audit risk is basically the risk that auditor expresses an inappropriate audit opinion. Okay, he gives a inappropriate audit opinion when the financial statements are materially misstated. Okay, so when the financials are materially misstated, ideally, guys, okay, what kind of opinion should he have given? When the financial statements are materially misstated, he should have given what kind of opinion? Let's say if there is misstatement, he should have given either qualified or, let's say, adverse. Okay, but then he ended up giving unqualified opinion. Okay, let's say, then this is going to be called as audit risk. So again, I'm reading the definition, guys. Audit risk means what? Audit risk is the risk that uh, uh, that auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. Now be careful about the entire definition, the last part also, when the financial statements are materially misstated. So sometimes what happens, students end up thinking that, okay, let's say there is no misstatement in the financial statement. Ideally, the chartered accountant, the auditor, must have given unqualified opinion. Yes, if there are no misstatements in the financial statement, he should have given unqualified opinion, but then somehow he ended up giving qualified opinion. Now, will this amount to audit risk? The answer is no. This is not audit risk. This is something probably which is very rare, and only person, an auditor who is perhaps of unsound mind, is going to do this. Okay, so remember, what is the definition of audit risk? Audit risk basically means that there were misstatements in the financial statement, but then we expressed an inappropriate opinion. So we did not qualify the opinion, or we did not give an adverse opinion. Rather, let's say we gave unqualified opinion. So this is what is the meaning of the word audit risk. Okay, now when I say audit risk, what are the components of audit risk? Very simple. We are not going to go into the detailed discussion, but yes, always remember, guys, that audit risk is it comprises of inherent risk, control risk, and detection risk. And inherent and control risk, they are collectively called as risk of material misstatement. In your standards also, we would not be referring to the words inherent risk, control risk separately, but we generally, the word, uh, combined assessment is used, so we use the word risk of material misstatement. But just for your understanding, guys, what is inherent risk? In very layman's terms, guys, inherent risk means assuming that there is no system of internal controls. Okay, what it's basically the chances of misstatements that would be there in the financial statement, assuming that there is no system of internal controls. Okay, what could go wrong with the financial statements? Now, what is control risk? Control risk is, we are assuming that there are internal controls. Despite that, see, controls can never give us 100% assurance, right? So those misstatements which will not be, let's say, identified or detected or prevented by the system of internal controls. So risk remaining even after the internal controls have been implemented, risk which the internal controls will not be able to find. Basically, it's the control risk. Okay. And what is detection risk? Detection risk is the risk that our procedures, the procedures which auditor applies, okay, even after the application of his audit procedures, some misstatements might still be there in the financial statement. So this is called as detection risk. Okay, now, guys, Is inherent risk in the hands of auditor or management? Please tell me this. Answer this in the chat box, everyone. Is inherent risk? Inherent risk is something which is, Amrita is saying, in the hands of management. Inherent risk is something which is inherent to the business. It is there, it's a part and parcel of the business. Yeah, Jawar, you're absolutely correct. So inherent risk, even management might not be able to control it. However, yes, the management would try to reduce it by implementing controls. So the amount of controls, the level of controls they implement, okay, so they might somehow impact control risk. So management has the, you know uh, management can impact control risk. And when I say detection risk, okay, it's totally in the hands of the auditor. Okay, now you only tell me, if I want to reduce my detection risk, okay, that means I don't want that there should be chances of misstatements in the financial statement. I want my detection risk to be very low. In that case, what has to be done? In that case, the nature, timing, and extent of our audit procedures has to be increased. Yes, Pavi, you are absolutely correct. So we have to increase the nature, timing, and extent of our audit procedures, right? Now you have to always understand this. Let me just take you, I mean, we are discussing very briefly here. Okay, in my regular lectures, I almost spend 1.5 hours only on the concept of audit risk. Okay, we discuss practically also. And let me just uh, open this particular concept. We discussed this not only in chapter number 3, but in my regular lectures. If you have attended, we also discussed this in as a part of our fundamentals, right? See, we have this topic of audit risk here. And we have discussed all this in our regular lectures. But yes, you all know this, guys, that audit risk is what? Risk of material misstatement into detection risk. We have this equation, right? Just remember always that audit risk would be set by the auditors. They would set it at a very low level. Audit risk is something which is set at a very low level. No one would want to give a inappropriate audit opinion when the financial statements are materially misstated, right? So we would want our audit risk to be always low. Then this risk of material misstatement is assessed. How do you assess risk of material misstatement? Through inherent risk and control risk, right? You all know this, that ROMMS is equal to what? ROMMS is inherent risk into control risk. Okay, and guys, this equation practically is used to understand how much procedures we have to do in the audit. I mean, if you feel that your, let's say, ROMMS is very high, okay, then probably you might have to bring your detection risk to a low level. That means you will have to perform more audit procedures. You will have to, the nature, timing, and extent of your audit procedures would be very high here. Okay, anyways, I'm not going into the details here. I hope this is clear to everyone. Always remember, we have covered this as a part of our chapter 1 also, that guys, in due to inherent limitations of audit, we can't bring down the audit risk to 0. Okay, all right, just last thing, remember, detection risk is in the hands of auditor. If he wants to bring down the detection risk, he will have to increase the nature, timing, and extent of his audit procedure. That means he has to do more procedures. Okay. All right, now guys, when I say risk of material misstatement, okay, this is something which you cover in all the chapters, all the pages of your audit. And I mean, because this is just a revision series, right? I did not take this word earlier, but then in my, again, in my regular lectures, what we do is, in the, I have a chapter number 0, which is called as the fundamentals. And in this chapter, we discuss all the important terminologies of audit. If you can see, we have audit terminologies, right? And we have discussed all the important terminologies. And here we also discuss risk of material misstatement, right? So before even I started a chapter in my regular lectures, you are already thorough with these words, right? But then practically, I mean, we have to understand, right? So only in chapter number 3 we are going to learn now about risk of material misstatement. All of you know this in very layman's terms. What is risk of material misstatement? Risk of material misstatement means the chances of misstatements in the uh, financial statement, right? The probability that there would be misstatements in the financial statement. So let's read the meaning, guys. It says ROMMS is the risk that financial statements are materially misstated. Now, very, very important point to understand, guys. When do you assess this risk of material misstatement? You have to understand this. It has to be assessed prior to the audit, because only when you assess the risk of material misstatement, then you sit down to plan the audit, and then you go to the client's place and do the further audit procedures. So a very basic thing, I mean, you have to be very clear on this, that risk of material misstatement is the risk that financial statements are materially misstated. And when do you determine this? Prior to audit. And if you again go to the stages of audit that we had learned in the fundamentals part, guys, that is why if you see here, assess the risk of material misstatement, it comes as a fourth stage, fourth step. Only after assessing, then you do the planning, and only after fifth stage or fifth step, guys, we actually start the audit, perform audit procedures. So always remember that assessing the risk of material misstatement is something which is done prior to the audit. Okay, now when you assess risk of material misstatement, guys, you have to understand that risk of material misstatements may exist at two levels. At two levels. What are the two levels? We have two levels. Number one is overall financial statement level, overall financial statement level, and it could be at the assertion level, assertion level for particular class of transaction or account balance or disclosure. Okay, now we'll just understand some examples, okay, of risk of material misstatement at overall financial statement level. Now what does it mean? First, let's understand this. So when I say risk of material misstatement at the overall financial statement, this means that uh, this is something that misstatements which relate pervasively to the financial statement as a whole, and it may affect many assertions, it may affect many assertions. Now for example, let's say there is a misstatement in the profit. So when there is a misstatement in the profit, it would impact a lot of other things, right? Maybe that they have inflated the sales, maybe they have cut down on their expenses, whatever it can be, right? Let's say they have shown less profit, so maybe they have booked some bogus expenses in their P&L. So a lot of things may happen. Let's say, guys, I feel that the management of the company or the accountant of the company is not competent. They are not competent. So when they are not competent, they might not be doing the accounts properly, and when they are not doing accounts properly, it might impact many assertions, right? So you know when I say risk of material misstatement at the overall FS level, what does it mean? This means that the misstatements would relate pervasively to the financial statement as a whole, and it may impact many assertions. Okay, next, guys, it can be individually, I mean account wise, it can be for a particular transaction or an account balance or a particular disclosure. So assertion level for classes of transaction, account balance and disclosure, it means it is assessed in order. Now please understand, uh, the ROMS at the assertion level, it is assessed to determine the nature, timing, and extent of further audit procedures, to express an opinion on the financial statements, and to basically bring down the audit risk to an acceptably low level. Okay, now in very simple terms, if I tell you guys, all of you know this now, that this risk of material misstatement, right, it is determined at two levels. One is what? FS level, and the second one is the ABCD level, or let's say the assertion level. Okay, now please remember, I'll teach you this soon, that ROMS is actually assessed as per SA 315. Now once you determine the ROMS at the FS level and at the assertion level, then for the ROMS which is there at the financial statement level, okay, you are going to have some overall responses, okay, in accordance with SA 330. And for those as misstatements which are there in one particular transaction or account balance or disclosure, then what is it that we do? We determine the nature, timing and extent of further audit procedures to be applied. That means again as per SA 330. So the equation that we have been using, that okay, ROMMS is equal to inherent risk into control risk, this is actually for the assertion level. Okay, but because for those misstatements which is at the FS level, you are only going to make some overall responses. Okay, we are going to learn about the responses part as a part of SA 330. Where is it that we calculate risk of material misstatement? As a part of 315. Okay, all right, let's go back to the chart, guys. Very simple. Now, do you think is there any relationship between ROMS and detection risk? We have already discussed this, guys. I discussed the equation that say audit risk is equal to what? ROMS into detection risk. Let's say I feel that the ROMS is high. In that case, what is it that I have to do? I mean, I would always want my audit risk to be low. So I would have to bring down my detection risk. Okay, so always remember guys that there is an inverse relationship. There is an inverse relationship between, I had a diagram also. Yeah, this one. See, there is an inverse relationship between ROMS and detection risk. The higher the ROMS, you have to bring down the detection risk. And how do you bring down the detection risk? Of course, by performing more audit procedures, right? Done. So what is the relationship between ROMS and detection risk? Just one word probably you'll have to understand. Yeah, there's an inverse relationship. Okay, so yes guys, we are done with the concept of audit risk. We have covered ROMS as well. Okay, now let us quickly go through the concept of assertion. Again, a very important concept. Now what is it that we have to cover here, guys? This is a word which you come across in almost all the chapters of audit. Again, what is the meaning of the word assertion? Assertion means the claims, the facts made by management regarding certain aspects of the business, the facts. So if you see the financial statements of a company, okay, and let's say there is land and building there. So land and building, let's say 3 lakh rupees or 3 crore rupees. Okay, so it is conveying to us a lot of information. It simply means first that the land and building exists. Okay, and then it also means that land and building belongs to the company. Okay, that the company is the owner. It also means that the land and buildings value is 3 crore rupees. Okay, so and it also means that the company has the right to use that asset, right? Because it's their asset, right? So when you see the financial statements of a company, probably you would just read it as land and building 3 crores, but then it is conveying a lot of facts. So these are the facts or the claims which is made by management, that is called as assertions. Okay, now as an auditor it becomes important for us, because in audit we are going to apply procedures to test each of those assertions. Okay, so like for example, when I say land and building, okay, we have in the balance sheet, let's say it's 30 lakhs. Okay, so it conveys a lot of information. I told you that it conveys an information that land and building exists, so we have existence. It conveys an information that land and building belongs to them, so we have ownership rights and obligations. Okay, then it gives a information that the valuation of land and building, let's say, is 30 lakhs. So we as auditors, what we are going to do, we are going to apply procedures to test each of these assertions. Now for example, whether land and building exist or not, what procedure can we apply? We'll apply physical verification. Whether the land and building actually belongs to the company or not, we might check the title deeds, right? And whether the valuation of is 30 lakhs or not, we might see some documents, we might ask for the certificate from the valuation office or something like this, right? So we have to, this is the reason guys why the word assertion becomes so very important in our audit. As an auditor, we are going to test each of these assertions by applying the necessary procedures, right? Now for your understanding, you have to remember that assertions, guys, we have to learn the assertions at 3 levels. Okay, so yeah, we have 3 levels of assertion. One is transaction level, then we have account balance. That means the account balance is what, the balance sheet. Transaction level is the P&L assertions, account balance, and then finally something with respect to presentation and disclosure. So we have assertions for at different levels. Okay, now for account balance, I'm going to start with the balance sheet first. So what are the assertions? Number one, see again, consider that example, land and building. What does it mean? That number one, land and building exist, that the assets and liabilities and the shareholder equity balances, whatever it is, okay, as stated at the end of the accounting period, that exists. Okay, then that building belongs to the company. That when I say belongs to the company, that means the company has the right over that building. So it's a right, asset is a right and liability is of course an obligation. Okay, then 30 lakh rupees, it's the valuation, right? So it also conveys to us the valuation of the building, the carrying value. Let's say when I say valuation, basically assets, liabilities and equity balances have been recorded at proper valuations or not. And other than, let's say, land and building of 30 lakhs, they don't have any other land and building. So it also conveys that the company has disclosed all the land and building, and the total of land and building is coming as, let's say, 30 lakhs. So we have completeness assertion. That means all assets, our liabilities or equity balances have been fully reported. So remember, we have four CRVE: completeness, rights and obligations, valuation, and existence. These are the four assertions for balance sheet items or account balances. Okay. Then we have transaction level assertions. We have five of them: accuracy, classification, completeness, cutoff, and then we have occurrence. Okay. Now, what does accuracy mean? It simply means that full amounts of all transactions are recorded. Let's say we are checking advertisement expense. Advertisement expense is 3 lakh rupees in the books. Okay, so it means that the 3 lakh rupees is correct. Full amounts of all transactions are recorded. There is no error. Number one. Second, the advertisement expense has been properly classified. Okay, it has been put in the correct ledger. The classification is proper. It should never happen something of revenue nature you have capitalized, etc. Then advertisement expense 3 lakhs. That means again accuracy means without error, and completeness means that other than this there is no other advertisement expense. That means 3 lakh rupees represent total of the advertisement expense. It's complete. All business events are recorded. I mean, everything with respect to advertisement is recorded. Cut off means advertisement expenses of 3 lakhs is reported in the correct accounting period. It means all transactions were reported or recorded, sorry, within the correct reporting period. Okay, it should not happen that advertisement expenses pertaining to, let's say, next financial year you are showing it in this year. Nothing like of this sort should happen. And advertisement expenses, guys, you are going to show it in your books only when the transaction has actually occurred, that the business transaction actually took place. Okay, so all this five assertions you have to remember: accuracy, classification, completeness, cutoff, and then we have occurrence. Okay. All right, so yes, guys, we have completed two levels of the assertions. Transaction level, we have completed the account balance also. Now last is presentation and disclosure. When I say presentation and disclosure, we have again four assertions: accuracy, completeness, occurrence, and rights and obligation. Presentation and disclosure can be with respect to balance sheet item and P&L also. So we have accuracy, completeness, occurrence, rights and obligations. Let's say it's a requirement of AS 18 that all the related party transactions should be disclosed properly. So then we'll see these assertions: accuracy, completeness, whether the transaction actually occurred, rights and obligation, if it of course pertains to assets and liability. Okay. All right, so remember, the concept of assertion is an important concept. In our regular lectures we have also discussed some practical questions also. In once in the old course it was asked, they gave you a statement. Let's say you are the auditor, you are doing a procedure. Let's say you are wanting to check year end. You do an year end physical verification, inventory physical verification. What assertions are you trying to test? So in our regular class we have discussed all this. Just doing a quick revision now, guys. Okay. All right, so yes, in chapter number 3 we have covered the basics part. We have already covered what is audit risk. We have covered, guys, what is meant by uh, yes, risk of material misstatement, and then what is meant by assertions also we have covered. Okay, now two things we have to study together. We are going to take up SA 315 and also the concept of internal controls. Okay, two things. Now SA 315 is a really very important standard. And what is this standard about? Identifying and assessing the risk of material misstatement. See, we just covered the concept of risk of material misstatement, right? How actually are you going to identify and assess risk of material misstatement? It is given as a part of SA 315. And the name itself says that you have to identify and assess the risk of material misstatement through understanding the entity and its environment. You have to understand the entity and its environment, and then only you are able to assess the risk of material misstatement. And this is what, guys, we have been learning right from the fundamentals chapter. If you see, assessing risk of material misstatement comes as a fourth step of our audit process, right? And how did you arrive at this? See, obtaining an understanding of the client, that means entity, and its environment, including internal controls. Only this part when you do, you are going to be in a position to assess the risk of material misstatement. And this we are going to learn as a part of 315. Again, read the name of 315: obtaining understanding of the entity and its environment. Okay. Identify and assessing the risk of material misstatement through understanding the entity and its environment. But then I told you, you have to have knowledge of internal controls also. That is why if you see, the next topic that we have is on internal controls. So both of them we have to understand together, and then only you would be in a position to identify and assess the risk of material misstatement. Once the risk of material misstatement is assessed, then we'll learn about how the auditor is going to respond to those risks. In essay 330 we are going to learn about it. Okay, anyway, so let us quickly now start, guys, with essay 315. Very, very simple standard again. And many students, let me just tell you this, I have observed that many students at the intermediate level, I don't know why they find the standards of essay 300 series, very boring. But then if you understand them properly, guys, it's quite interesting. I mean, it's not boring, it's not tough at all. Okay, you have to understand the proper flow, proper logic of this standard. Okay, all right, so let's begin, guys, with essay 315. What all things we have to cover? Only two things. See, objectives and then some requirements of the standard. So what is the objective, guys, of 315? Of course, it says to find risk of material misstatement. This standard will teach us. The objective is basically to assess, to find the risk of material misstatement. At what levels? At two levels. I already told you this. We at FS level, financial statement level, and at the assertion level. How? The point is, sir, through understanding the entity and its environment. We have to understand the entity. We have to understand its environment and their internal controls. Of course, when I know about all these things, then only I'll be able to assess the risk of material misstatement. And sir, why do we even find risk of material misstatement? Because when you find risk of material misstatement, guys, at the FS level or at the assertion level, then only you will be able to decide as to what has to be actually done in audit. I mean, this will help you. It is going to provide you with a basis for designing and implementing responses to the assessed risk of material misstatement in accordance with which standard? SA 330. So did I not tell you this? Just for your understanding, guys, for risk of material misstatement at the FS level, what kind of responses will be designed? We design overall responses. And for risk of material misstatement at the assertion level, what kind of response we design? We determine the nature, timing, and extent of further audit procedures to be done. Okay, anyways, nobody is going to ask you about the objectives in the exam. This is, but I feel it is always important to understand the crux of the standard. I mean, understand the logic as to why this standard is there in your course. Then it becomes very easy to follow a standard. Okay, now let us start, guys, with the requirements of the standard. Only if you can see, guys, we have how many points? Only 4 points to cover. Okay, very simple. 4 points we have to cover in this particular standard. Okay, remember, guys, this is a standard which teaches us how to find the risk of material misstatement. Yes, though I'm in my regular lectures, before I cover this standard, we take up essay 500, right? But now, because it's a revision series, I'm going chapter wise, right? I have not yet touched essay 500, but in my regular lectures I take it like in, as in like after 200, 210, 230 we take up essay 500, right? Now please understand, in essay 500, you know we learned, and in revision sessions we'll be doing it, don't worry, that audit procedures can be, we have to learn about two types of audit procedures. One is RAP and the second one is FAP. Okay, and you have to understand that when you do a risk assessment procedure, when you apply risk assessment procedure, you get something called as risk of material misstatement. Okay, so, and in further audit procedure, what is it that we do, guys? We do test of controls, and we also do some substantive procedures. And when I say substantive procedures, it could be test of details, it could be substantive, let's say, analytical procedures, right? You know all this, right? Now, why did I even bring this concept here of SA 500? Because you have to understand, how are we going to get ROMS, find ROMS, assess ROMS, by applying which procedures? Sir, we have to do RAP, risk assessment procedure, and we are going to learn about this now in 315. So let's see this. RAP, can you see RAP? RAP is risk assessment procedures and related activities. So it says, guys, the auditor shall perform RAP. He has to do RAP to provide as basis for identification and assessment of ROMS. So to identify ROMS, you have to do RAP, and to identify ROMS at both levels, FS level or assertion levels, you have to perform RAP. Okay. Now, sir, when we do RAP, will it give us sufficient and appropriate audit evidence? No. I just told you, in as a part of 500 also, you would be covering it, that RAP, I mean, by itself, RAP is not going to give you sufficient and appropriate audit evidence. You actually have to do the testing, right? You have to do the test of details. You have to see whether the controls are operating effectively or not. So we also have to do further audit procedures. So remember guys, RAP by themselves do not provide sufficient and appropriate audit evidence. Okay, now what, how will I get to know about this? How will I identify and assess risk or material misstatement? I mean, you are saying, sir, that we have to do RAP, but what exactly I'm going to do in RAP? I am yet to start my audit. I have not yet started my audit. Remember guys, very crucial thing, many students, I mean, they kind of overlook this aspect. Let me take you back to the definition of ROMS. What is ROMS? It is a risk that financial statements are materially misstated prior to audit. That means, sir, we have not yet started the audit, and now you are saying you have to do RAP. Yes, that means what? Let's discuss this very practically. Okay, I'm yet to accept the I'm yet to start the audit. Okay, but then let's say you are the management of the company, and I'm just doing a casual discussion with you. Okay, then I say, sir, I saw your financial statement, sir. I feel that you have done a lot of transaction in cash, and because of this I feel that there is a high chance of misstatements in your financial statement. I'm just doing a discussion. No, 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 management tells me, no, 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 sir, what are you even saying? Yeah, yeah, we do a lot of transaction in cash, but we have got good controls for that, sir. So we give vouchers, we give invoices, we give money receipt to all our customers when they pay in cash. Good thing. Second, sir, all the cash that we collect in a day, we count it, we reconcile it, we make a BRS, we ensure it is deposited in the bank also. Okay, good control. And sir, because we have a lot of transaction in cash, we always have two persons sitting at the cash counter. All of these they are saying. So what will it make me believe? Oh yeah, I can see that they have done a lot of transaction in cash, but at the same time they have a lot of controls also. So this is just a discussion that I'm doing, right? So RAP is what? RAP will include, see the point, inquiries of the management. I might make inquiries of the management. I made an inquiry. Hey sir, I see a lot of transaction in cash. What are the controls you have? So they will respond to the inquiry. I might do some analytical procedures also. When I say analytical procedure, it means, guys, it means that okay, if there's a lot of fluctuation in the financials, I'll compare the current year financials with the previous year, right? So if there is a lot of fluctuations, I might feel, oh, their GP ratio this year is gone up or low. I might do an inquiry for the same, and then when I know that okay, the GP ratio or some of the expenses, let's say, has fluctuated a lot, there might be a misstatement. This might be a case, right? And then I can even go for observation and inspection of entities, operations, documents, and reports. For example, let's say the moment I entered the office, I saw that there is a security guard, there are cameras everywhere, and yeah, there were two persons at the cash counter. So I observed a lot of things, right? So RAP, please remember, guys, of course it's a part of our audit, but then when we assess, it's not the real audit, I mean, that we have started, right? So generally it is said that ROMS is assessed prior to the audit. Okay, and you have to do all these things: inquiring of the management, analytical procedure, and it may include observations and inspection also. Now if you see first point, guys, it says inquiries of management and others. Yes, who are the others? I mean, from whom can I make the inquiries? So I've just written certain points. Okay, the inquiry can be, guys, with respect to, you can make an inquiry with TCWG, it can be with the internal audit personals, it can be with the employees of the company, it can be with the in-house legal counsel, it may be with the marketing or sales personnel, it may be with the IT team members, it may be with the risk management department. So I can go and talk to and inquire from all the employees, all the departments of the company. If you are able to recall, in essay 210 we read certain preconditions to an audit, right? And there we also covered this aspect that auditor shall be having, or he should be getting, unrestricted access to all their employees also. Okay, all right. So these are, guys, things that we do as a part of RAP. Done. So it's over. It's the first portion is over. What did I teach you? How do we assess risk of material misstatement? Sir, we assess risk of material misstatement by doing RAP. Sir, what is it that we do in RAP? We can go for inquiry, we can go for observation, inspection, we can even do analytical procedures. Okay, done. So the first part is over. Now, guys, how actually do I arrive? What all things will I be asking? Sir, you told us in RAP we have to inquire, but about what things do we have to ask? Sir, we need to first know the entity and its environment, including its internal controls. See the point. Understanding of the entity and its environment, including internal controls. Now, again, in this standard, this is the heart of the chapter. because unless you have a proper understanding of the entity, its environment, their internal controls, you would not be able to assess the risk of material misstatement properly. And if your assessment of ROMS is not proper, guys, your planning for further audit procedure, of course, would not be appropriate. So it's very important for us to have the correct assessment of risk of material misstatement. Please be very clear. Some students end up thinking that when I say you have to assess risk of material misstatement correctly, that see, risk of material misstatement is just an expectation. It's just a probability. It's just a likelihood that these are the chances of misstatements in the financial statement. It's not an exact amount or value. Please be very clear about this. Okay. Anyway, so what are the things now that you have to obtain an understanding of the entity and its environment? Okay. Now, guys, let's say I'll give you one simple example. Okay. Um, let's take the case of two companies. One company is into jewelry business, okay, and one company is into a very simple trading company they have, okay. They a small, let's say, store, and they are only having 5 to 10 items, okay. Now you are assessing risk of material misstatement, and one aspect of risk of material misstatement is understanding the inherent risk. So automatically it might come to your mind, assuming that there are no internal controls, the inherent risk would be high in case of jewelry business. Why? Some of you might think that, sir, jewelry business, the value of the goods are very costly, it's very pricey. The other trading shop might not have costly items. Jewelry is, of course, expensive thing, right? But then try and understand, yeah, because of the nature of business, you are feeling that, yeah, the risk of misstatements in the financial statement of the jewelry company might be high. It might be high because the price of gold, let's say, it keeps on fluctuating also, but the trading company, the goods that they are selling, the prices are fixed. So the chance of misstatement might be high in case of jewelry business. And then accordingly, you are now going to ask the management, I feel that in your business there might be misstatements chances because gold prices have fluctuated a lot during the entire year. Sir, what controls do you have? Management will be like, yeah, we understand that the gold prices have fluctuated so much, but we do have controls, don't worry. So what is it that I'm trying to convey through these examples? I'm trying to tell you that, guys, I would be in a position to assess risk of material misstatement by understanding two things. I need to know about the entity, its environment. So let's say I know, okay, jewelry business, because of the it has an inherent characteristic that the gold prices will go up and down, so I feel there might be misstatements. But then management is like, no, don't worry, we have very good controls for this aspect. Every time, guys, there is a fluctuation in the gold prices, we have a note of it. We do the transactions on the current prices only, on whatever is the latest prices. So management kept on telling me about a lot of controls. So what would I now believe? Oh, okay, they have good controls, that means the chance of misstatements would be low. So always understand, see, this was a very layman's way of conveying the concept, that always remember, when you are assessing risk of material misstatement, you have to understand entity and its environment, including what? Including their internal controls. You just have to obtain an understanding. Did I even check the controls yet? No. It's just that management told me. Do you not remember that I told you in RAP, we just inquire, we observe, we inspect. So on the basis of that, actually you do the assessment of ROMS. We have not yet actually tested the controls. Testing of controls, guys, will be done as a part of FAP. Okay. So understanding of the entity and its environment, what all things you have to understand, guys, here. Here, two things. What are the let's say you want to know more about the entity, you want to obtain information about the entity and its environment, what all factors would you consider? Very important question. What all things would you, as auditor, would consider? Or what are the aspects that you should be knowing with respect to entity and its environment? So there are 5 points, guys. It says SA 315 requires the auditor to obtain an understanding relating to 5 aspects of the audited entity. So this may be asked as a question, guys, that you are the auditor, you want to obtain understanding about the entity and its environment. What are the aspects that you need to obtain knowledge about? So there are 5 aspects. What are the 5 aspects? Let's read the names first. 5 aspects. What are the 5 aspects? You need to know the industry, to which the company belongs. You need to understand, you need to know the applicable laws, regulations, what FRF is applicable on them. These are the basic things, guys. Okay, now imagine you are a chartered accountant, you come to me to do the audit, okay, and I we are a software development company, let's say, okay, and you check the balance sheet, and while you are checking the financials, you say, sir, I can't see threat outwards. So probably if you give, if you have such issues in the audit, if you point out such issues, sir, everything looks fine, but I can't see threat outward. Array, this is a software development company. How will I deliver software through a truck or through transportation? It is delivered through cloud. Okay, so why would be there even a case of, let's say, threat outwards in case of software development company? It won't be there, right? So what I'm trying to tell you is, you shouldn't be sounding very bullish in front of your client. So you have to have first a better understanding of the entity, the what kind of business they are into, okay, what industry do they belong to, what are the applicable laws and regulations on them, what kind of FRF is applicable on them, what how should they be making their financial statements. So number one thing, you have to obtain understanding of this. So remember three words: relevant industry, regulatory and other external factors. Okay, now just to go deeper, I mean, just to define these words, what I have done, what is relevant industry, guys? I mean, you have to consider industry factors. Industry factors would mean what? Let's say it might be competition, the relationship which is there between the supplier customer, what has changed with respect to technology. All these things we have to, as auditor, understand. When I say relevant regulatory factors, it means what accounting principles, is there any industry specific regulations or government policies that the company should be following. Okay, and then there can be other external factors also, like economic conditions. How is the overall economy, whether we have a recession now, what is the inflation rate, what is the interest rate going on. All these things also you should be aware of. Okay, then only you'll have a good understanding of the entity and its environment, right? So first is relevant industry, regulatory and other external factors. So industry, regulatory and other external factors we have just understood. Okay, all right. Next is, you have to have an understanding of the nature of the entity. You need to know about the nature of entity. Now, when I say you need to know about the nature of entity, it means what? You need to know about their operations. Okay. You need to know about their operations. You need to know about their governance and ownership structure. You need to know as to what type of investments do they make. Do they have a lot of subsidiaries, etc., and how they are actually financed, whether they have a lot of equity or debt in their capital. All these things are basics, right? So nature of entity, it's operations. What is meant by operations, guys? Operations as in, you need to understand from where are they generating revenue, what is the source of their revenue, what products or services are they selling, do they manufacture themselves or they buy it. All these things you have to understand. You need to know their ownership and governance structure, then what type of investment it makes. That means, what where does this company made, have they made any acquisitions this year, whether they have made any capital investments, do they have any investments in joint venture, subsidiary, etc. Then the way the entity is structured and financed, that means whether it is mostly equity, or it has been, this company's capital structure consists of more or debts. You have to know all these things, right? So in point number two, guys, nature of entity, remember four things. Nature of entity means operations, number one, ownership and governance structure, types of investments it makes, and the way the entity is structured and finance. You have to know all these things. Okay, all right. So we have covered 2 points. What is it that we are studying, guys? We are studying what are the factors, what are the aspects that you as an auditor have to obtain an understanding of if you want to know more about the entity and its environment. So two things we have covered: relevant industry, regulatory and other factors, and then nature of entity. Third, you have to understand about the entity's accounting policies. Very simple. What accounting policies do they follow, or is mandatory for them? And then entities objectives and business strategies. You need to also know about the business strategies of the entities, because business risk, that it may result in risk of material misstatement. Now what does this mean, guys? It simply means that you have to understand whether they are planning to expand. Let's say, if they are, let's say, planning to expand, what could be the risk associated with company growth. Now let's say they are planning to expand, they want to procure more loans, and to procure more loans they might show inflated sales and all, inflated turnover. So it's a risk of material misstatement, right? So you need to understand your business, the entity's business strategies, the business risk. Okay, let's say they are introducing new product. What if the product doesn't really work, and the company doesn't want to show that the product has not picked up in the market? Again, they might inflate the sales, and also all the business strategies might also have an impact on the misstatements in the financial statement. So yeah, you have to know about the business strategies. And also, guys, when you are doing the audit of a company, you need to know how the entity is performing. That means you have to have an understanding of the entity's financial performance. That simply means you need to know the KPIs. KPIs is basically key performance indicators. Like for example, you need to understand some important ratios, the trends. You need to know the operating status statistics. You need to analyze their financial performance. I mean, you can compare it with their budgets, if they have made any forecast, if variance analysis, etc. So you need to know, in simple words, whether it is a profit making company, loss making company. You can just go through all the important KPIs, ratios, etc. All right. So yeah, this is done, guys. And again, let me tell you what is it that we have covered here. You have to cover this five aspects to understand the entity and its environment. Again, I'm just going through the 5 points. Number one is relevant industry, regulatory and other external factors. Second is nature of entities, including these four things. Nature of entity includes four things: operations, ownership and governance structure, the type of investment the company makes, and how the entity is structured or financed. Next is entities, the process of selecting the accounting policies and their business strategies, and finally the performance. Okay, but this is not enough. This is only going to give you an idea as to how the entity is and their environment is, right? But then I told you, to assess the risk of material misstatement, you have to consider two things. You have to consider what? Internal controls also. Now please understand this, guys, that when you understand the entity and its, let's say, environment, when you understand the entity and its environment, what happens? It will give you an idea about the inherent risk. Okay, and when you understand the internal controls of the organization, it will give you an idea as to whether the controls are good or not. It will give you an idea about the control risk. And when you combine these two, what is it that you get? RMS is nothing but combination of inherent risk and control risk, right? So that is why we have just covered this part now, that in order to identify and assess risk of material misstatement, you have to understand the entity and its environment. But then the next part is left. We also have to understand the internal controls, guys. So let us understand internal controls. Though the point entities internal controls, we are going to cover this in detail in as a part of this portion. You have, can you see this? We have a separate topic of internal controls, this one, guys, right? So we are going to cover it here. However, what about internal controls do you need to obtain information, basically? So it's a very basic point, guys. Auditors should obtain understanding of those internal controls which are relevant to the audit. I call it as ICRA. I mean, there can be n number of controls in an organization, but all controls are not going to be relevant for our audit. I always give this example. Let's say we are the auditors of an airline company, an Indigo Airlines. Okay, so we are the auditors of the financial statement of the company. We would not be concerned whether after every flight lands, whether they check the tires or not, whether they check the um, uh, rate balance of the flight or not before taking off. All these are very important. It's very important for the operations of the entire airline, but it is not a control which is relevant for my audit. I am only concerned with those controls which are relevant to my audit. Now, for example, in case of Indigo Airlines, whether a passenger cancelled his ticket, whether refund was issued to him or not, whether proper amount of refund was given to him or not. So we have controls for that also. Now this is a control which is going to be relevant for me, because ultimately the amount is going to be a part of the financial statement, right? So remember, guys, that organization can have many different controls, but we as auditors are only going to be interested in those controls which is going to be relevant for our audit. Okay, and hence we are going to evaluate the design of ICR and determine if they have been implemented. Now the question that might pop up in your mind basically is, sir, what aspects, what things about internal controls are we going to check? Are we going to check every control, whether they are there in place, whether they are operating properly or not? So this standard teaches us that if you want to know about the controls, whether the controls of the organization are good or not, or the control risk is high on the other hand. So what is it that you have to understand? This standard tells us that you have to obtain understanding about five components of internal controls. Okay, what are the five components? Very simple, guys. The five components of internal controls are: control environment, number one, control environment. Then we have risk assessment process. Then we have information system and business processes, control activities, and monitoring of controls. So you have to have an understanding of these five elements of the control Okay, and then once you have an understanding of these five elements, you would be in a position to know whether the internal controls are okay or not. We are going to learn about these five components of internal controls here, guys. I'll just show it to you, though I'll tell you about the basics. If you can see, in internal controls we have components of internal control. So all these five components, we are going to cover it in detail in this part of the chapter. However, just for your sake of understanding, what I've done here is I've written one line against each of them, if you can see. So what is control environment? Now control environment simply means the overall attitude, the seriousness of management with respect to internal controls, whether there is a culture in the organization to follow the controls that they have designed. So this is control environment. Then guys, always remember, who is responsible for the internal controls in the organization? It is the management, right? So have they randomly just installed or implemented internal controls, or they did a proper risk assessment? Because guys, it shouldn't happen like this, that I have implemented a particular control because my neighbor was doing it. If I actually face the risk, I should implement the controls. So before implementing internal controls, as a prerequisite, there has to be something called as risk assessment process. Every organization should do a thorough risk assessment process, and on the basis of the risk that they face, they should be implementing the internal controls. So then I as an auditor would want to know whether you have a risk assessment process or not, and then whether you use systems and processes to generate and communicate financial information, whether the financial system information that you make, the financial statements that you make, whether you are doing it manually or whether you are using systems and all. Then whatever risk you face, control activities means it is the policies and procedures implemented by the entity to mitigate risk and achieve objectives. That means the real controls which the management has implemented. And finally, only by implementing controls also might not be very helpful. Whether monitoring is done, whether by the management, basically about what, whether the controls are followed or not. And it says review processes in place, review policies, review controls in place to monitor the effectiveness of internal controls over time. So whatever controls the management is implemented, whether it is still relevant, whether it is still effective or not. So as an auditor, I need to obtain understanding of these five components of internal controls. Now for example, if I say, guys, the management of the company is very serious about internal controls. Now this increases the probability that everyone in the organization must be following controls. So that means the chances of controls being good is very high. On the other hand, I mean, on the contrary, if I put it in this way, management is least bothered about internal controls. The top management, they hardly care about controls. All they want is just to get sales, increase the figure of sales. So in that case, if they are not serious, I might conclude that overall environment of control is not good in the company. Then let's say they randomly implemented controls without doing a risk assessment. So that means the chances of their controls to be good is now going to be very less. So all these factors, all these components, I would see to basically check about their internal controls. Don't worry, we are going to learn about this later on as a part of our internal controls topic. Okay. However, after this two, what is going to happen, guys? What we have done as of now, we have done. We have understood how to gain an understanding about the entity and its environment, including its internal control. When you gain an understanding about these two things, what will happen? Now you are in a position to identify and assess the risk of material misstatement. And I have been telling you this, at what levels are you going to identify and assess risk of material misstatement. So if you can see the next point, identify and assess risk of material misstatement. Now you have the knowledge of the entity and its internal controls. So now you identify and assess risk of material misstatement. Okay, so it says, having obtained and documented an understanding of the entity and its environment, the auditor is now in a position to assess the risk of material misstatement, and at both levels, at FS level and as well as the assertion level. Okay. Now, guys, let's say we have identified and assessed risk of material misstatement. Let's say, uh, just hypothetically, I'm putting it in this way. Let's say we feel that there are misstatements in 5 areas, but all the misstatements might not be equally dangerous. Okay, I'm just discussing in very layman's terms. So we have to prioritize that. Okay, I need to tackle this misstatement first, then this misstatement, etc. Right? So please understand, once you are done with identifying and assessing risk of material misstatement, you have to prioritize. Okay, some misstatements might be very severe. It might require your special attention, and those misstatements which require auditor's special consideration or attention would be called as significant risk. Okay, so it says, an important part of assessing risk of material misstatement is that risks identified should be prioritized. Okay, it says important part of assessing risk of material misstatement. Once you have assessed, you have identified and assessed risk of material misstatement, now you have to prioritize, guys. Okay, and why do we need to prioritize? This is because 315 determines that risks which are of significant nature, the risk which is of, we call it as significant risk, it requires what? Special audit consideration. Okay, now I've put a star mark here. That simply means we are going to learn about, guys, certain factors now. Certain factors uh, which will help us to determine whether this risk is a significant risk or not. Okay. Now let's say, guys, we found, you all know that misstatements can happen either because of fraud and error. Okay. Now let's say I'm just asking you. Okay, I want you to answer in the chat box, guys. Let's say my question is, you have identified two misstatements. One is on account of fraud and one is on account of error. Which one do you think is more dangerous or more significant? Where will you put your more attention? RMS arising out of what? Fraud. So in this topic, guys, I am going to teach you the factors which the auditor might consider in determining whether this misstatement is a significant risk or not, whether this risk is a significant risk or not. So it says, number one thing you have to understand, guys, it's a matter of professional judgment whether a risk constitutes significant risk or not. It's of course going to be a matter of professional judgment, right? But we are going to consider, we have certain factors to be considered, in determining whether a risk is going to be a significant risk or not. So what are the factors? See the point. Number one, whether the risk is risk of fraud. So number one is, if the risk is on account of fraud, then it is going to be a significant risk. When the risk is because of, the transaction is very complex in nature, then it is going to be a significant risk. Complexity of transaction, you have to put in special attention. Okay, now very important. Whether the risk is on account of transaction with related parties, then it becomes a significant risk. Why? Because, guys, if let's say the company wants to do some ghapla, some fraud, they might engage it with related parties. They will not be doing it with strangers, right? So let's say I want to book, my profits this year was very high. It was, let's say, coming to 9 lakh rupees, and I know one of my relatives, he doesn't, fall above the taxable limit. So what I did is 2,50,000 rupees or 2 lakh rupees, I booked an expense in my books, consultancy charges to my relative, and I give him 2 lakh rupees bank transfer, and then I ask him to give me back the cash. So it will not matter to him, because what is going to happen? Anyways, 2 lakh rupees income he can show, he will not have to pay any taxes, and I have saved taxes here, and I get back my 2 lakh rupees. So there can be frauds with related parties. So when it comes to transaction with related parties, it's always a significant risk. Remember, transaction which is very complex, significant risk. Transaction with related parties, significant risk. Okay, then transaction, this one point, I'm reading this point first. Transaction which is outside the normal course of business, which is not a regular thing, something which is very unusual, which was done outside the normal course of business, it will be a significant risk. Things wherein there is a lot of subjectivity involved, there is no precise measurement. Okay, let's say provision and all, where management feels they have just made a transaction, when where there is no objectivity but there is a subjectivity involved, then it is a significant risk. Okay, and then we have a point whether the risk is related to significant changes, let's say in economic, accounting, or other development changes because of economic, accounting, or other development. So all these are basically factors that would help you to determine whether a particular risk is going to be called as significant risk. Very important topic. Okay, done. So what have we done, guys? So I told you first something about RAP, and then we learned about how to obtain understanding about the entity and its environment, including the internal controls, and then we were in a position now to identify and assess the risk of material misstatement. Right now, the point is, once you have identified and assessed the risk of material misstatement at the two levels, what is it that we have to do, sir? We have to prioritize. We have to see, I mean, if there is any risk which requires our significant auditors attention, basically, sir, those type of risk would be called as significant. This is what I have taught you. Okay, done. And finally, guys, okay, so again, I'm asking you before I take up the next topic, guys, when do you assess the risk of material misstatement? Is it before the audit, during the audit, after the audit? Prior to audit, right? But then what happens, let's say, I was having a discussion with the management that you do a lot of transaction in cash, and then they said, no, we have controls for it, don't worry. So I thought that, okay, the ROMS is here. Okay, but then when I actually do the audit, when I went to the client's place, and I saw, and I was trying to test the controls. They told me they make BRS every day, they deposit cash every day in the bank. Then I asked the management accountant to give me the BRS. He did not have the BRS. I asked him, if when was the last time the cash was deposited? Sir, I think it was done a month ago. I don't know. I mean, we have the cash, it's in the tijori, it's in the vault. We did not deposit. I mean, whatever controls management had told initially, none of them are present, or none of them are, let's say, effective. So in that case, what is going to happen? Sir, the controls are not there only, or let's say it's very poor, it's not effective. Then the ROMS that I had assessed here earlier, ROMS is going to increase. And when my ROMS increases, what happens, guys? You'll have to change your plan. You have to change your further audit procedure, etc. Right? So the point says, if you see the last thing, revision of ROMS, it says, as additional evidence is obtained during the course of audit, when you do the audit, let's say when you do the test of controls, ROMS may change. And when your ROMS changes, what has to be done, guys? The auditor shall modify the further audit procedures accordingly. Okay. All right. So yes, with this, if you can see, yes, we have covered essay 315. So up until now, guys, in this particular chapter, what all topics have we covered? We have covered audit risk, we have covered risk of material misstatement, we have assertions, and we have covered in detail the standard 315. All right, guys. So far in chapter number 3, we have covered audit risk. We have covered the concept of risk of material misstatement. What is assertion? We covered the different types of assertions, and we have also covered the standard 315. 315 was basically about identifying and assessing the risk of material misstatement through understanding the entity and its environment. Okay, but then I told you that it is, for the auditor to identify and assess risk of material misstatement, he has to understand the entity and its environment along with internal controls. Okay, just to make you understand, guys, again, in 315, I told you that you have to obtain understanding of the entity and its environment, so including its internal controls. And in the concept of internal controls, I did tell you this, that we are going to learn a lot about internal controls in the next topic basically. Okay, so always remember, guys, when you're doing 315, you have to cover the concept of internal controls along. Okay, so let's start now with the concept of internal controls. We have a lot of theoretical aspect to cover in this particular topic, as you all can see, and we'll begin with some basic things. What is the meaning of the word internal control, guys? All of you have to remember that these are processes, these are policies or processes. When I say internal control, okay, it would always be in the form of some policy or process of the company. Remember that internal controls are designed, maintained, implemented, or let's say they are implemented, or they are designed, implemented, and maintained by management as well as ECWG of the organization. They are responsible for the implementation, design, and maintenance of internal controls. Okay, now just to give you an example, guys, let's say the company says any payments that we make above rupees 5,000 has to be authorized by this officer. So it's a control. They don't want any bogus payments to be made in excess of rupees 5,000. So they have a control. Let's say all the payments would be first approved or authorized, and then only the payment process will be done. So it's an example of internal control. You see so many times when you go to some shops, some restaurants, where at the cash counter you'll always see two persons sitting there. Why? Because the restaurant will handle a lot of cash probably, let's say, and they have two people. It's called as dual control, so that if intention of one person becomes bad, I mean, there is a check, immediate check. Okay, there is one more person, right? So it acts as what? Control. So any business organization that you go into, guys, you will see that each business's process, I mean, will be subject to some sort of internal controls. Okay, now as an auditor, I did tell you this, that we would be concerned with not all the internal controls, but we would be concerned with internal controls which are relevant to our audit. Okay, so what is the definition? Let me just complete the definition again. These are internal controls, are processes or policies which are designed, implemented, and maintained by TCWG and management. Now, why would a company have internal controls? Internal controls provide reasonable assurance about the achievement of four objectives. About the achievement of objectives with regard to, we have four objectives. Number one, if internal controls are there, the reliability of financial reporting would be higher. Then they can carry out their operations effectively and efficiently, all operations. Okay. Then if they have controls, they would be able to safeguard their assets. Now, for example, very basic concept, right? All of us, when we go out of our house, we lock it, right? Why? We are safeguarding, it's an asset. We have so many things in our house, we want to safeguard it. When we sleep at night, we ensure that the main gates and everything is closed. It's again a part of what? Internal control, right? That's the layman's example. And internal controls also ensure that the company does all the compliances with laws and regulation. Now imagine it, let's say, guys, we have to make a payment. Okay. And when we make a payment, as per income tax act also, we have to deduct, let's say, the tax, TDS. Okay. Now if the company doesn't have good controls, they might end up paying, let's say, the entire 2 lakh rupees. They would not deduct TDS on it, which is a requirement as per income tax act. Then again, it's a violation of the income tax act, right? So internal controls ensure that the company achieves the objective of complying with the laws and regulations also. All right. So remember, guys, I'm reading the definition for the last time. The process, what is internal control? It is a process designed, implemented, and maintained by management or TCWG. Why? Because it gives reasonable assurance that the entity will be able to achieve its objectives regarding four things. What are the four things? Number one, reliability of financial reporting, effectiveness and efficiency of its operations. Third is safeguarding of assets. And the next one is compliance with applicable laws and regulations. Fine. Okay. Now, guys, this internal controls will only give reasonable assurance. Please be very careful about it. None of the controls, I mean, can give you full guarantee. Okay, controls will also give you reasonable assurance. I mean, I'll again take a very simple example that, let's say, guys, you have laptops or you have mobile phones, and for laptops, let's say we buy antivirus also. So even if you buy the best of the antivirus, okay, it won't give you a guarantee that, virus is not going to penetrate your system or enter your system or damage your system. There's no guarantee. Okay, we all took the shots of this COVID vaccine, but then it doesn't give a guarantee, right, that COVID will not happen, right? So no control basically will give 100% foolproof guarantee. Hence, always remember, guys, that controls will also give us only reasonable assurance. But why? I mean, there are certain inherent limitations of control. There are certain limitations of control, because of which controls are only going to give us reasonable assurance. So we are going to now understand limitations of internal control. Please be careful that the inherent limitations of audit we had covered as a part of SA 200. It's a different topic. Now what is it? What is it that we are covering? We are covering limitations, inherent limitations of internal control. Okay, so we have got six points, guys. Number one is cost effectiveness. Cost. Okay, guys, all internal controls will come with a cost. So the management, before they think of any control, they will be doing a cost benefit analysis. Okay, so they might not be procuring or installing very expensive or controls also, because there's always some cost involved. No control will come for free. So cost, it's a resource, right? The money that we have to pay for it. So this is a limitation. Next, even if you have the money, but let's say you get the best of the controls. Okay, let's say I got a very good control for this door, to this room, let's say. But then it's a very automated digital kind of lock, and it has all the passcodes and pin. And I instructed my staff that, okay, when I'm done with the class, you have to lock it in this way. But he has not understood it. He did not understand my instructions, and he somehow was not able to lock. Okay, and then something bad happens, let's say. So what has happened here? Even if I had purchased the best of the controls, but management, let's say the employees, the management, they did not understand the instructions properly, and hence the control became a failure. Okay, so human errors is also one of the reasons. Then I was giving you this example, right? That at the cash counter, you'll often see two people sitting together, right? Why? Because if one person's intention becomes bad, at least the other one is there as a check. Okay, but then what if they both make a partnership and do 50-50? Let's take all the cash today, let's do 50-50. So people might come together and make plans, right? So collusion among people Even if we have the best of the controls, what if people come together? What if forget about the employees? What if management is only involved in the perpetration of fraud or something? So this is always a limitation. Next is change in conditions. Guys, we had implemented controls, but then we have not yet updated it. Let's say a very layman's example, let me give you. Let's say we had installed some CCTV cameras, okay, way back, and this CCTV camera doesn't have the capability to capture night vision. I mean, at night when it is dark, it can't record anything, it's all black. So with time, guys, the technology is upgraded, we need to change, right? So we have to ensure that our controls are still relevant or not. Okay, so many times what happens, they become obsolete, and when it becomes obsolete, it is going to be of no use. You might feel that yeah, you have controls, but it is not working. Okay, then judgments by management. Now this is a very important point, guys. See, how many controls we have to implement, what controls we have to implement, it's a matter of professional judgment. Okay, so if management feels that okay, this is the risk we are facing, this is the level of control we need, it's okay. But then if management feels no, this is the risk we are facing, they might need higher level of control. So what amount of controls, what type of controls are needed, at what point of time is the control needed, all these decisions are basically totally based on management's judgment. If they feel that the company is facing a lot of risk, they might be really serious about controls, else not. So controls, guys, it's all about management judgment. There is no concrete formula that if this is happening, you have to have this control. No, it's about management's judgment. Okay, and then guys, we have last point, limitation in case of small companies. Limitation in case of small companies. Now uh, let's say there's a very common good internal control which is called as segregation of duties, right? And segregation of duties means that one task from the start to the end will not be given to one person. I mean, there has to be division of responsibility. More people should be involved in the completion of the task. Let's say, you have to divide the task and give it to different persons. This is segregation of duties, because if you give the entire task to one person right from the start to the end, he might indulge in fraud, he might do fraud, and others will not even get to know. So we have segregation of duties, right? It's a very simple and very common control which which we see in a lot of organizations, right? However, in case of small companies, guys, let's say I only have one employee, then how will I go with segregation of duties? It's not possible, right? He will have to do he will be doing, let's say, all the tasks. So in that case, segregation of duties might not be possible. But then what can we do? So we might have to think of some alternative, different types of controls there, right? Segregation of duties might not be possible, but let's say I might have to implement some monitoring system. Let's say I implement a software of monitoring whatever he does on the system, on the computers. So we might have to have some different controls there, right? Anyway, so guys, we are done with limitations of internal control. Please remember, I mean, we have covered six points here, right? And this question has also been asked in the exam. All right. Okay, now coming to the next topic, guys, I have told you this, that as auditors we shall not be concerned with all the internal controls. Remember, I gave you the example of Indigo Airlines, right? If I happen to be the auditor of Indigo Airlines, it's a very essential thing that yes, they have to check upon the tires after every landing. They will check the fuel, they will do all the necessary checks to ensure that the flight is safe for the next sector, right? These are all very important controls, very important from the perspective of all the passengers as well, the safety of passengers, right? But then they might not be really very important from my financial audit perspective. But on the other hand, I told you, whether let's say passenger has cancelled the tickets, whether he has got the refund, whether the right amount of refund has been issued to him, whether the cancellation fee has been duly collected by the airlines or not, all these might be important for my audit. Why? Because all this are going to be reflected, let's say, will impact the financial statements. Okay, so I will have to see whether these controls are operating properly or not. As an auditor, I might not be interested in seeing whether the control with respect to the maintenance and changing of tire after every, let's say, some flights, etc., whatever the controls they have, whether they are being followed or not, might not be very important. So always remember, we will be concerned, guys, with controls which are relevant to audit. So it says controls relevant to audit are typically controls over financial reporting. So all controls over financial reporting, I would be concerned. So I've just written a basic line here, guys. An entity might be having or might have controls relating to objectives. that are not relevant to an audit. So, ensuring that the tires are okay, ensuring that the plane is safe for the next sector, all these are very important controls, but they are not relevant to the audit, and therefore I need not consider them. Okay, done. Okay, now, so see, the theoretical part, the basics we have covered. With respect to internal controls, guys, we have covered the meaning, we have covered limitation, and we have also covered what is ICRA, controls relevant to audit. Okay. Now, what is it that we have to cover? We have to cover the most important part of the topic of internal controls. A very basic thing, however, but it is most important. Remember, I told you this in SA 315. I was telling you repeatedly that, guys, the auditor has to obtain understanding of the entity and its environment, including internal controls. Okay, but what about internal controls? Should the auditor obtain understanding of? Okay, so the standards tells us that if you are able to obtain information about these five components of internal controls, you will have a good understanding about internal controls. So now we are going to learn about those five components of internal controls. Okay, so please remember, guys, first let's just read the names. What are the five components? Number one, control environment. Then risk assessment process. Mind you, it is not risk assessment procedure which the auditor does. It is risk assessment process which is to be done by the management of the company. Third is about the information systems. Fourth is actual controls which is relevant to the audit. And finally, monitoring. So these are the five components of internal control. Again, why as auditors do we need to have an understanding about these five components? Because if you have understanding about these five components, overall you will have a good understanding about the internal controls of the company. Okay, so what is meant by control environment? Let's understand first the meaning. Guys, control environment means what? Let's understand. It says this term refers to the attitude of the management, the company, and the staff regarding internal controls. Just remember the word attitude. Simply means how serious they are with respect to internal controls. In simple words, again, guys, see this point. Do they take internal controls seriously, or do they ignore them? Okay, and if the controls are taken seriously, this greatly will enhance the overall, robustness of the system of internal controls. Guys, this is the, I can say that this is a foundation of the entire system of internal controls, because if management is not serious about internal controls, the other components that you can see will not be considered, will not be very good. Only when they are really serious about internal controls, remember this line: the strengths in control environment provide appropriate foundation for other components of internal control. Now please remember this, a question might be asked using this sentence also. Do you agree with this, that strengths in control environment provide appropriate foundation for other components of internal control? Okay, only when management is serious, when they have this attitude that yes, internal control is important, we need to really be serious about it, then only all the other components will be effective, will be good. Okay, now the basic of control environment you already know. However, one very important question which may be asked from this part is, guys, okay, basics, that control environment means, sir, we have to check attitude of the management, the employees, etc. But when I want to know about the control environment of this organization, what exactly will I be seeing? So we have to learn about certain elements, guys. There are 7 elements, very important question of the control environment. Okay, so this can be asked as a separate question. What are the elements? Let's understand. We have some 6 7 points here. 7 points. Number one is communication and enforcement of integrity and ethical values. Communication and enforcement of integrity and ethical values. Guys, understand it very practically. Let's say we are all a part of the organization. You are the employees, and I'm one of the senior management. Some of you have recently joined the company. How will you get to know that these are the things which you have to do? These are the things which you shouldn't be doing. I mean, how will you get to know the controls? How will you get to know the policies that you have to follow? How will you get to know the do's and don'ts? So very important thing is, guys, only by framing internal control policies is not going to help you. We have to communicate the same to the employees. We have to, you know uh, tell everyone in the organization that yes, you have to follow this, these are the do's and don'ts. So very important point is communication and enforcement of integrity and ethical values. We have to communicate, right, that you can't take bribes. We have zero tolerance policy towards this. So all these are communicated, and you will realize this, guys, once you become a chartered, let's say, and then you join a corporate. So the moment you join, they will send you a lot of documents in the form of policies. These are basically the do's and don'ts of the company. So very important thing is, number one, proper communication has to be there. Else employee might say, sir, we did not even know that this has to be done. How will we get to know? So that's why I'm saying that, the controls will be effective only when the proper communication is done. Second, commitment to competence. Second is commitment to competence. Now guys, you know we have to ensure that in our organization we hire competent people, we hire right people for the right job, then the chances of errors and all will be less. Okay, so if guys, imagine, if even if we have the best of the controls, but then we are not hiring the right type of people, people are not able to understand their jobs and all, their responsibilities, then of course the controls will also be of no help, right? So we have to be committed that yes, we are going to appoint competent person. And with respect to this, point number two, if you can see, I would want you to read immediately point number seven. Two and seven are somehow related to human resource. Two says that we would be only recruiting competent person, and seven says we have to have good HR policies, human resource policies and practices, in the sense that we have to have policies and practices with respect to recruitment. After recruitment, let's say we have to give them orientation, make them familiar with their job. There has to be proper orientation, there has to be proper trainings, there has to be a proper system of promotion, compensation, rewards, all these things in an organization. Then only the organization will I can say prosper. Okay, so we have to have the right people in the organization. So point 2 and point 7 elements, these two elements are with respect to HR. So you can think of it as to, you can write them as to one after the other, basically two, and then you can also write seven. Then third point, I mean, this is participation by TCWG. Guys, the more serious the senior management of the company is, the more they are involved in the design, maintenance, implementation of internal controls, everyone would also be serious. I mean, all the middle level managers, the lower level managers, the employees would also be serious about internal controls. However, if top management themselves are not uh, much participative, they are not very serious about internal controls, you can't expect the others to follow the same, right? I mean, can't expect the others to be following the internal control. So very important perspective, important point to see is what level of participation is there by TCWG. And then along with TCWG, we have a point with respect to management. It says management's philosophy and operating style. I mean, this means how, again, how does management take the internal controls? Maybe the TCWG is serious, so is management also serious? What is the attitude of management towards internal controls? So this is a point with respect to management. Okay, now you have to understand this, guys, that one very important aspect of control environment in the organization is the organization structure. Okay, now what is, I can put it in this way, that organization structure in itself is a control. I mean, what is organization structure? Organization structure is basically how the organization is, the hierarchy of the organization, right? So who is going to report to who is at the top, who are the subordinate managers, who is at the middle level manager, who are the middle level managers. So this has to be fixed. Else, if there is no organization structure in the company, well, the employees will not know whom to report. One manager will not know whom to deliver or whom to delegate the responsibility or assignment to. So there will be a chaos in the organization, right? So a very important aspect for an organization is to have the organization structure. And point number 5, that means the organization structure, and this you can just link them together: assignment of authority and responsibility. So if you have a proper organization structure, guys, then only the jobs can be properly assigned. The jobs can be, there would be assignment of delegation of authority and responsibility. Without organization structure, this would be a chaos. Okay, so remember, guys, these are the 7 elements of control environment. Let me tell you this again, guys. In exam, they may ask you a question: what are the 5 components of internal controls? In that case, you don't have to define the elements of control environment in detail, but then they might ask you as a separate question: what are the elements of the control environment? So remember, there are 7 elements of the control environment. Okay, All right. So yes, let's just summarize control environment, guys. What did I tell you? It's all about the attitude of the management, the TCWG, towards internal controls. It simply means how serious the organization is with respect to internal controls. Okay, but then, guys, you have to also understand this aspect. Now I'll just make you just make an analysis here, guys. See, you all know that internal controls is the responsibility of the management, right? But how do they even implement the internal controls? Are they just randomly going to implement internal controls just because their competitor has implemented, or just because their neighbor has implemented? The answer is no. See, we can't just randomly go and implement internal controls. Internal controls will come with a cost. Only when you face certain risk, then only you are going to install or implement, let's say, or have the necessary internal controls. So always remember, guys, that as a prerequisite to internal controls, management will always do something called as risk assessment. They would first want to know what risk they are facing, and accordingly they will now implement internal controls. So who does this risk assessment? This risk assessment is also done by management. So I, as an auditor, would now have to see whether this company has a process of risk assessment, because only when they have a process of risk assessment, they would be able to understand the risk that they face, and accordingly they would have implemented the appropriate controls. Now, if an organization doesn't have risk assessment process, or let's say risk management process, the controls that they would have implemented would not be that good or relevant. So hence, it's a very important aspect for me as an auditor to see when I'm overall trying to obtain an understanding of the control that your organization has. So I need to know whether you have a proper system or process of risk management or not. Remember, risk assessment or risk management is a prerequisite before the management implements internal control. So coming back to the chart, we have this point, risk assessment process. It's not RAP, risk assessment procedure, that we do. RAP, if I use the word risk assessment procedure, it is something which the auditor does, okay, to identify and assess the risk of material misstatement. It is not risk assessment procedure, it is risk assessment process, which is done by the management. So the auditor shall obtain an understanding of the entity's risk assessment process, and in short, the auditor should evaluate whether management has identified its riskiest areas and implemented controls to prevent or detect errors of fraud that could result in material misstatement. So you have to understand whether they have a proper system of, guys, risk management or fine. Okay, I'm asking you this again. Who is responsible for this risk assessment process, guys? Risk assessment process. Is it the auditor or is it the management? Yes, tell me this, guys, again. Management, absolutely, yes. Okay. All right, yes. Next. Next is information systems. Now, see the word, basically, it's a big word, guys, big heading you have to understand. It says information systems, including related business processes relevant to financial reporting and communication. So we are basically discussing about what? We are discussing about, we in the third component is basically information systems, or let's say business processes. Okay, information systems or business processes. But this information system or business processes is related to what? It is related to financial reporting as well as communication. See, I told you, we are the financial statements auditor. I mean, we are the, or we are doing the audit of the financial statements, right? So when we have to understand the controls, we shall only be understanding those controls which are relevant to the audit. So this third point is about, we have to obtain information, we have to obtain understanding about the systems of the company, the processes of the company with respect to the financial reporting and with respect to the communication. So read the heading again. It says information systems, including the business processes relevant to financial reporting and communication. Okay, so what about this? What is it that you have to understand here, guys? Okay, now see, very simply, if I put very in very layman's terms, okay, let's say the company does all its accounting. The total accounting of the company, let's say, is very much automated. They do all the sales online, and all the sales entry and all is posted in the accounting system automatically. Then you only tell me, when things are done automatically, the chances of errors would be less. I mean, I can say that, yeah, when there is automation, they have better controls as compared to, if things would have been done manually. So you have to obtain understanding of these systems. See the points. What are the points that we have to cover here? Yeah. So what are the points? Information system, including related business process. So auditor should obtain understanding of the information technology. I should be able to understand the technology which the company is using. What is their accounting process? What is the communication systems and process? How do they do the accounting? I mean, is it totally manual or is it automated? See, what are the classes of transaction? How transactions are initiated, processed, and reported? Whether it is automated, whether it is manual. And I also need to see what are the systems with respect to communication. Sir, communication between whom? Communication between TCWG and management. It might be, sir, external communication also with regulatory authorities. I mean, let's say the company has received some letters from a particular department. So are they prompt in replying, or they just ignore it, or they are very casual about it? So all these aspects of communication also I need to know. So basically, point number three is about understanding the systems primarily relevant to financial reporting and communication. Okay. Then fourth point, control activities relevant to audit. Guys, this is the main point. I mean, when the management has done the risk assessment, they know that, okay, these are the risks that they face. Have they implemented the appropriate controls or not? So when I say control activities, this is nothing but the control which management should be implementing. So control relevant to the audit are typically controls over financial reporting. The auditor should obtain an understanding of control activities, the controls which is relevant to audit, and whether the auditor considers necessary to assess ROMS. Of course, we have to consider these controls, guys, to assess the ROMS. And once we assess the ROMS, of course, why do we assess the ROMS? To basically design the nature, timing, and extent of our further audit procedures. So control activities relevant to audit is the actual control. And then, guys, you also have to see one more aspect to understand, to have a good understanding about the controls. The last aspect is whether management monitors their control or not. And what does it mean? This component involves understanding how management monitors its control and how effectively it is done. Because I told you that controls might become obsolete, they might become outdated. So only when you monitor them, it would ensure that they are still, and you make necessary changes, then only we can say that yes, the controls are effective. So it says the best of the controls are worthless if the company does not monitor them and make changes when they are not working. So you have to have monitoring, guys. I mean, let's imagine that the company has installed 8 CCTV cameras, and after 3 months of time, 5 of them are not working, but they are least bothered. So is the control effective? No. So once the controls are implemented, they have to monitor also whether it is working properly or not, whether everyone is following the necessary controls policies or not. And then if things are not working, or let's say they might have to make corrective actions and all. Okay, so this is all about monitoring. So guys, done. We are done with the 5 components of internal control. Very easy topic, but very very important one. Okay, so next time when you are revising SA 315, guys, and then you happen to come across this point, entities internal controls. Okay, if you see, we have the 5 components here. Okay, so you can just read the 5 components that we have just covered in detail. You can read it along with 315 only. Okay, it's actually a part of 315, but in my material I did not want the students to feel that 315 is really very lengthy standard. So what I did is I divided, let's say, it into 2 parts. One is internal control and one is the basics of 315. Okay, all right. Next, guys, is evaluation of internal controls by auditor. Okay, now all of you know this, that auditor will evaluate internal controls. He will have to see the internal controls. He will have to obtain understanding of the internal controls. So the point is, first we are going to understand what are the methods which the auditor may use to obtain understanding, to evaluate the internal controls, and then we'll learn about what could be the benefits of the same. Okay, so what would be the methods? Very simple topic, guys. There are four methods given in our ICA material. So one is narrative records. Narrative record means that I would want to have a very complete and very exhaustive description about the internal controls. Let's say management has some internal controls with respect to inventory, so I would want to take, a very detailed description from them with respect to the control over inventory. It may be in the form of paragraph, it may be in the form of, a deep, very exhaustive explanation. But what happens, this is always in paragraph forms and all. We have a better option, which is flowchart. Flowchart will represent the same control over inventory, but it will be in the form of diagram, it will be in the form of some chart. Okay, and all of you know this, that it is always better to understand things in the form of chart, right, rather than the big text and explanation that we have. So charts are graphical representations. Flowcharts are basically graphical presentations, and it gives a bird's eye view of the entire internal control process. Okay, other than this, guys, we have two more methods. One is checklist, and the second one is internal control questionnaire. Now, checklist is basically a list of questions. The auditor is going to prepare a list of questions that, okay, with respect to purchases, we have to see this. With respect to purchase, we'll see whether purchase order was there or not, whether invoices, whether the company has made the payment only after matching the purchase order to the invoice, to the goods received note. So we are just going to write certain questions, and when we go to the client's place to do the audit, there will be options against the question: yes, no, not applicable. So the auditor is going to put tick marks, whether this control is there, yes, whether, oh, this control is not there, no. So all these things the auditor is going to do. But the same concept, the same set of questions, let's say, we have made certain set of questions against for internal controls, but then instead of the auditor answering those questions in the form of yes, no, not applicable, now it is being done by the management, the employees of the company. So we call it as internal control questionnaire. Internal control questionnaire is basically what? It's a series of questions on internal control, but to be filled by employees of the client. Please understand, checklist was also a series of questions, but it was filled by the auditor himself. But when I talk about ICQ, internal control questionnaire, it is filled by the employees of the client. That's the major difference between the two. Done. So these are the four methods, guys, which we have to cover with respect to the internal controls. These methods can be used by the auditor to obtain understanding about internal controls. Okay, now why would you even evaluate the internal controls? There are certain benefits, guys. Let's just go through the benefits. It says, let's understand few points. Yeah, so when you evaluate internal controls, when you actually assess internal controls, it will give you an idea whether there would be chances of errors and frauds in the financial statement in the ordinary course of business. Because if the internal controls are good, the probability of frauds is and errors also will be very less. Okay, the purpose of basically having internal controls is to prevent, detect and correct misstatements, right? And all of you know this, that misstatements happen either due to fraud or error. So one benefit when you evaluate internal controls is basically you will get to know whether there are chances of fraud or error happening in the financial statement. That means whether the misstatements might be there or not. So all of you know this, that when the internal controls are good, adequate, the chance of misstatements anyways, ROMS, might be low. Okay, then guys, when you evaluate internal controls, one more benefit is you will get to know whether internal control is adequate and effective. Okay, and along with this point, you can also read point number 8. Okay, you'll 7 and 8, you will also get to know if there are control areas which is weak. Okay, so it, one advantage again of evaluating this system of internal control is basically you get to know whether the controls are effective or not, whether they are weak. And if they are weak, let's say I found that this control is weak, I can always give suggestion to the management, right? Suggestions for improving the controls. Okay, now guys, the main reason, tell me this, what is the main reason that the why, as to why we evaluate the internal controls? So we evaluate the internal controls to assess RMS, and on the basis of this we would plan the nature, timing and extent of the procedures that we have to apply in our audit, right? So see the point, the extent and the depth of checking the auditor needs to carry out. So once you do the evaluation of internal controls, you'll get to know you'll get to assess the ROMS, and consequently you'll know the extent of procedures that you have to apply. Okay, and accordingly you might choose to apply appropriate procedures. Okay, then few more points, guys. When you see the internal controls, you'll get to know that yeah, they have good controls. That means their assets are safeguarded, that they, the financial statements reliability also increases, how reliable the reports, managements, certificates, etc. are. Okay, so these are certain benefits. You already know this, guys. Let's say if the internal controls are weak, and whatever certificate you take from management, you might not be able to trust them. But however, if the internal controls are good, you will feel that whatever certificates, whatever reports I have obtained is also accurate. Okay, so these are certain benefits of evaluation of internal controls. Now, I think this is not required now. Yeah. So the next topic, guys, that we have is about testing of internal controls. We have a topic which is testing of internal controls. This internal controls in IT environment is not there. We have an entire topic now, audit in automated environment. So is not required. Okay. So testing of internal controls. Now, please understand, testing of internal controls means what? I mean, when we are identifying and assessing risk of material misstatement, I want you guys to answer. When we are identifying and assessing the risk of material misstatement as per SA 315, do we test the controls there, or what procedures do we apply? I want you to recall. As per 315, I told you, when you do an RAP, what is it that you do, guys? Yes, tell me, guys. You remember that I told you that we only do inquiry, we might do observation, inspection, and we might do analytical procedures. So we just try to obtain understanding, guys, of the internal controls. We never test it. It's only when we actually go and do the audit, first thing that we do is testing of controls. Okay. So why is testing necessary? Testing is necessary to conduct. It is conducted to assess the effectiveness of both the design and the operation of internal controls. So testing of internal controls is like test of controls that we do. Okay, and it says auditor plans testing over a period, ensuring coverage of critical areas within a designated time frame like 3 years. So it might so happen that, guys, you are not able to test all the internal controls in 1 year. I mean, you are the auditor, so we have to plan it. I'm going to teach you more about this in SA 330. So we have to plan our audit in such a way that at least once in 3 years we are able to cover all the controls. Okay, so for 1 year we might do selective testing. I mean, at least ensure one third of all the controls you are able to test. Okay, then what are the methods of testing, guys? What is the method of testing? I told you, you can go for inspection, we can go for inquiry and observation, we can even reperform things. Like for example, let me ask you, let me tell you this question. The management, when I was having a discussion with them, they told all the payments in excess of rupees 10,000 are authorized and approved. So now I have started the audit. How will I test this? I'll ask them for the payment vouchers, and I'm only going to see whether the signature of the concerned person is there or not. Okay, so what am I doing here? Is it not an inspection? I'm inspecting the documents. I'm inspecting the purchase vouchers, let's say, or payment vouchers, not purchase vouchers. Sorry, I'm inspecting the payment vouchers. And when I'm inspecting the payment vouchers, I might not be very much interested here about knowing the amount, etc. Because at the moment, my objective is to see whether they have been approved or not. So I would only be concerned whether the signature of the appropriate management or authority is there or not. So it's an inspection. Yes, similarly, guys, I can do inquiry observation. So let's say, what is inspection? Reviewing documents supporting transactions to verify proper operation of internal controls, such as authorization. I gave you this example, whether payments have been authorized or not. Second is inquiry and observation, gathering information about controls. Uh, let's say, like determining who performs specific functions. So I might ask, okay, who takes care of the inventory, who is the who is the go down manager, who is the store manager. I can ask this, so I can get to know about the controls by inquiry and observation also. Sometimes, guys, I might re-performance. I might do a re-performance. Okay, now let's say company told me, sir, we make a BRS every day. we make a BRS. I had asked them that, I had told them, sir, you do a lot of transaction in cash. There might be a misstatement. So they gave me an assurance. No, no, sir. We tally, I mean, our cash and the bank balances, I mean, they ensure that it is always tallied. We make a BRS. So you may, what you can do is you may prepare a BRS yourself also. It's like reperformance. So independently executing procedures or controls originally performed by the entity, such as let's say bank account reconciliation. And if they maintain, if they do a lot of things on the system, guys, then it can be like you are assessing controls over specific applications or the overall IT function. So we'll read more about this in the audit of automated environment chapter. But then testing computerized systems means either you can test one particular application, we call it as application control. You can test the general things in the system, whether they have a user ID password, so we call it as general IT controls, or ITGC, information technology general controls. Don't worry, we are going to learn about this. Let me just show it to you. If you can see controls in automated environment, we have these type of controls: general IT controls, application controls, IT dependent controls. So these are certain basically methods of testing the controls, guys. Please mark this as important. It might be asked inspection, inquiry, observation. It may be reperformance, and then you also have to test computerized systems. Okay, then guys, after you do the testing, what is it that you have to do? So results of these tests, results of the test determine if internal controls are functioning as intended. Okay, now you only tell me, guys. Management had told me, sir, we make a BRS every day, on the basis of which you thought, okay, risk of material misstatement for cash is less. Okay, but then when you actually did the audit, when you are doing the audit, you saw that they have never made a BR. What is going to now happen, guys? The risk of material misstatement with respect to cash that you had assessed earlier, it might be higher now. So please understand, it says deviations may prompt. If there is deviation, that deviation means what? That the control is not there or not followed. So deviation, they were not making BRS, so it's a deviation. Deviation may prompt revisions in assessed control risk level related, and it might lead to revision in your RMMS, and consequently will it need you to revise the further audit procedures that you have to do? Yes, leading to adjustments in the planned substantive procedures. Are you all clear with this evaluation part? Do you all agree with this? Yes, is this clear? Okay. All right. So, see, guys, with this, yeah, we are done with the topic of internal control. So many concepts we have covered, guys. Now, the best thing, guys, with respect to these charts is you need to know, exams. You have to have this knowledge that, okay, sir, with respect to internal controls, these are the topics we had covered. We covered meaning of internal controls, then we covered the limitations of internal controls, then we covered ICR, internal controls relevant to audit, then we covered components. Okay, sir, there were 5 components, but yeah, in component number one, control environment, there was some extra topic, elements of control environment. So how many elements? Oh, we read 7 elements. So you need to map things, topics in your mind like this, guys. Okay, so see, conceptual clarity is very important, but at the same time, if you want to score extremely well in the subjective area, a bit of retention, a bit of smart retention, smart way of studying is required, and these maps, these charts are going to help you in that. Anyways, my main book, my textbook, the textbook that you all must have got, it's also in very tabular format and all, which is very easy to understand and very easy for you to remember the points. Okay, all right. So with this, guys, again, let me just zoom out the master chart for you. So we have covered so many topics from this particular chapter. Yes, we have covered uh, yes, we have covered audit risk, risk of material misstatement, assertions, 315 also we have covered, and we have also covered internal controls. Now, as per the chart, the next standard that you can see is 320, but I would be taking 330 first, because we have just completed 315 and we have assessed the risk of material misstatement. Now, how you are going to respond to this risk of material misstatement is something which we are going to learn as a part of essay 330. So let's complete 330 first, which says auditor's responses to the assessed risk. Assessed risk. Where did the auditor assess the risk? Sir, in 315. What kind of risk did he assess? Sir, risk of material misstatement. At what levels did he assess the risk of material misstatement? Sir, at 2 levels, at FS level and at the assertion level. Okay. So 315 is basically about assessing the risk and how are we going to tackle and respond to this risk. We are going to study this as a part of essay 330. Okay, so let's first take 330, and then guys, we are going to go back to 320, and there is one more topic left in this chapter, which is audit in automated environment. Okay, so auditor's response to assess risk. There are certain topics, if you can see here. First, let's understand the objective of this standard. Very basic, very simple thing. The objective of the auditor is to obtain sufficient appropriate audit evidence about the assessed risk of material misstatement. So whatever risk of material misstatement he has assessed, he will now be obtaining sufficient and appropriate audit evidence about it through designing and implementing responses to those risks. Okay, so what responses will he be making? So there are a lot of requirements that we have to see here, guys. Okay, so there would be two responses. I think I told you this yesterday also. Let me see again if I have the chart here. No, okay, I'll just draw it once again for your understanding. So as per 3.1, I think I have it here. Okay, so as per 315, guys, as per 315, what did we do? We assess the risk of material misstatement. Yes or no? We assess the risk of material misstatement. Okay, and at what levels did we assess? We assessed at the FS level and at the assertion level. Let's say for pass of transaction, account balance, or disclosure. Now we have assessed the risk of material misstatement already. How do we respond to this? So if it is a risk of material misstatement at the financial statement level, that means it is a misstatement which is pervasive. Okay, so we are going to design overall response for it. Okay, and if it is a misstatement pertaining to a particular class of transaction, account balance, or a disclosure, then we are going to basically uh, you know design something called as further audit procedure for it. That means, let's say, we are going to basically have what kind of uh, um, response, overall response here, and then we have further audit procedures here, and all of you know this. What is included in further audit procedure? It would be test of controls, or let's say substantive procedure. Okay, all right, so these two concepts now we are going to learn in essay 330. So what would be the overall response? Okay, now guys, you only tell me, if the misstatement is not just confined to one particular class of transaction or account balance. Misstatements might be there throughout the financial statements. It's, let's say, pervasive. It's a FS level ROMS. So what response? How should I respond? How should I tackle it, guys? So there are certain overall responses which I have to design. Okay, so I have mentioned this in my example here. So overall responses, what would be the overall responses? Let's first understand this. So what is overall responses? It is basically design and implement overall responses to address assess risk of material misstatement at what level? FS level. And what is overall response going to include? Overall responses includes, guys, you have to understand this. Okay, it says number one, that I would ask my entire team again. I would just remind them, yes guys, there are misstatements at the FS level. You have to be more alert. You have to exercise. You have to maintain the attitude of professional skepticism. Now when I know that there might be misstatements which is pervasive in the financial statements, I might not be keen on sending the less experienced team members. I would only be sending, or asking experienced team members to be, to I will assign them to do the audit work. So assigning more experienced staff, or those with specialized skills, or using experts. Then, because it's a risk of material misstatement at FS level, you would also be now doing more supervision to their work. Okay, and guys, you have to incorporate elements of unpredictability in further audit procedure. Of course, you are going to do FAP, but these are the extra things that you might have to do for the overall response. Okay, so overall, because the risk of material misstatement is pervasive, you have to be more alert. You have to have a team of experienced persons, skilled persons, maybe an expert also. You have to exercise more supervision, and then you have to include a lot of elements when you are doing actually the further audit procedures. Okay, but then guys, when you know that the risk of material misstatement is not pervasive, it is just related to one particular, let's say, transaction or account balance, etc., then in that case you are going to do further audit procedures. Now you all know what further audit procedure means. What these are, further audit procedure, you have to design and perform FAP whose nature, timing and extent are based on and are responsive to the assessed risk of material misstatement at the assertion level. So what could be the types of FAP, guys? Can anyone answer this again? What are the types of further audit procedures? Please write it in the chat box. Yes, Deepika says TOC, okay, test of controls, and not SAP would be substantive analytical procedure. Yeah, substantive procedure is correct. Yes, Amrita, you are correct. So what are the types, guys? We have test of controls and we have substantive procedures, and all of you know this, that substantive procedures I can divide it further into what? These substantive procedures, can I divide it further into test of details and analytical procedures? Yes. Okay. And now this test of details I can also further classify. Okay. If you are checking on the uh, um, transactions, I will be calling it as, let's say, vouching. And if you are concerned with the balance sheet items and all, you're checking them, it is called as verification. Yes. Vouching and verification. Absolutely. Okay, so all of you know the types, right? Now, the entire standard, see, we have covered the basics, guys. Okay, now the entire standard is going to revolve around these two things. Okay, we have already learned the overall procedures, overall responses, that yeah, the auditor has to exercise more supervision, has to have an expert team, experienced team. He has to maintain and ask his team members to be more alert during the audit. All this we have learned, right? Now, the main focus of this entire standard would be further audit procedures. And all of you know, if you can see the next 2 points that we are going to cover, test of controls and substantive procedures. So we are going to discuss the further audit procedures here in detail. Okay, so let's start with the test of controls part, guys. Okay, we have a lot of points to understand, but it says number one, test of controls are designed and performed to obtain sufficient appropriate audit evidence. So why is, why do we even do the test of controls? We do the test of controls, guys, to obtain sufficient and appropriate audit evidence about what? That when the auditor expects controls to operate effectively, whether the controls are operating effectively. And guys, you do a test of controls because sometimes substantive procedures alone will not be able to give you enough evidence or sufficient audit evidence at the assertion level. So why do we even do or go for test of controls? Number one, you want to gain evidence with respect to the operating effectiveness of the controls, and guys, only by doing substantive audit procedures probably uh, it will not give you sufficient appropriate audit evidence. Hence, we resort to test of controls. Okay. Now, this was basic. But then, sir, what about the nature and extent of test of controls? What is it that we have to check when I say test of controls? What is the nature and what is the extent of test of controls? Okay. So, with respect to nature and test of controls, guys, very simple. In designing and performing test of controls, when I talk about nature, what is it that we will be concerned about, guys? So in designing the test of controls, what are we going to be concerned about, sir? Perform, yes, it says, see, in designing and performing test of controls, the auditor should perform other procedures alongside inquiry to assess the operating effectiveness of control. So you have to do inquiry, but then other than inquiry also you might have to do some procedures. So perform other audit procedures alongside inquiry, then evaluate how controls were applied and how consistently were they applied, who are the ones who are actually responsible for the controls. All these things you will have to know. So when I say nature of controls, guys, we are studying what? Nature and extent of test of controls. So you have to understand that you have to perform uh, yeah, you have to perform some audit procedures in combination with, let's say, inquiry. Okay, and then to assess whether the internal controls were effective or not, were operating effectively or not, and then you have to see how the controls were applied, whether they were followed consistently or not throughout the year, who are the responsible parties. Okay, and sometimes what happens, guys, determine if tested controls, whatever controls you have tested, they rely on some other controls. Okay, so they are dependent very much on some other controls, so you'll have to also see the effectiveness of those other controls. We call them as indirect controls. One control is dependent on the other control. You have checked this control, so to check whether this is effective or not, you might have to now check the indirect control also. So determine if tested controls rely on other controls, that means indirect controls, and assess their effectiveness also. Okay, now please understand this, guys. Inquiry alone, please understand this, that inquiry alone is insufficient for testing controls, and other procedures are also necessary. Only by asking is not sufficient. So what could be the other procedures, guys? Did I not tell you? Can we do an inspection? Did I just tell you in the chapter of internal controls that, let's say, we want to see whether payment vouchers have been authorized or not? So we will have to do inspection. Only by inquiring, hey, do you authorize all the payments above 10,000? They will say yes, sir. But will it give you sufficient evidence? The answer is no. You will have to basically perform some other procedures along with inquiry. So we might have to go with inspection. Can we also do reperformance? Yes, sir. So they said we have made a BRS. Good, they have made. You can also make one and then reconcile. I mean, see whether their BRS, your BRS is okay or not. So it is basically what? Reperformance, right? Now, guys, so I have, what did I tell you? I mean, see this point. When you're designing and we are performing test of controls, what is it that you have to do? You have to do inquiry, but then inquiry alone will not provide you sufficient audit evidence, guys, sufficient evidence. Okay, so what is it that you have to do? You have to perform other audit procedures in combination with inquiry, number one. Second, you also have to see that how the controls were applied, were used in the organization, were followed in the organization, then whether it was consistently followed, who are the parties responsible for it, and then if the control that we have tested it is dependent on some other control, we also have to see the effectiveness of that indirect, the other control also. Done. All right. Now, the point, one more point, one topic which I feel might be important. Factors considered in determining the extent of test of controls. Now, how much test of controls will you be checking? What are the factors to be considered in determining the extent of test of controls? Okay, very, very important question. Okay, in your main material also, I've included it as a part of the questions also. So, what are the factors considered in determining the extent of test of controls? There are 5 points, guys. Number one, frequency of control performance by the entity during the audit period. How frequently was the control being used? Frequency of control performance by the entity. How important was that control? I mean, what is the frequency with which the entity was using that particular control? Number one. Okay. Second, length of time the auditor relies on the control's effectiveness. Now, for example, guys, do you want, will you only be seeing whether the control was effective as at the end of the year, or you are concerned whether the control was effective throughout the period? So, depending on that, you will basically decide on the extent of checking you want to do. For example, guys, if you are only concerned with whether the control existed as on 31st March, so you might just want to see things as on 31st March, right? But then if you want to make sure whether the controls was in operation, operated effectively throughout the period, you might have to check a lot of other things also. I mean, check on other dates as well, right? So what is it that we are discussing? We are discussing on what factors will the extent of our checking of controls, extent of test of controls depend. Number one is very important point, guys. How frequently, what was the frequency of the control performance by the entity? Okay. Second, what is the length of time the auditor relies on the control's effectiveness? Then third, expected deviation rate from the control. What is deviation? Deviation is basically, we will learn more about it in the chapter of audit sampling also. But then what is deviation? When control is not working as intended. So if you are expecting that, yeah, more deviation will be there, the payment vouchers would not be signed. If you are expecting, so you would have to increase the extent of your testing, right? So if you are expecting deviation, you will have to increase the extent of your testing. Okay. Then relevance and reliability of audit evidence regarding control effectiveness at an assertion uh, level. So the evidence that you get about controls effectiveness, relevance and reliability of audit evidence regarding control effectiveness at the assertion level. So guys, if let's say you apply one test, Okay, you are doing one test of control, but you are not satisfied, you are not happy with the evidence that you have got, or you are not convinced with the evidence, with the response to the inquiries that you have made to the management. You are not very convinced with that, you feel it is not very reliable, so then you will have to do more testing. So if you are not satisfied, if you are unhappy, if you feel that the information, the evidence you have obtained is not very reliable, you'll have to resort to more testing. Okay, and extent to which evidence is obtained from related controls. Now I have already, let's say there are two controls related, I have obtained a lot of information already from this control, so maybe for the other control which is related, I might not have to resort to much testing, right? Now this topic is very difficult. Why? Because it will require you, of course, along with understanding, it will require you to have some retention about of the points. So let me repeat it again, guys. What is the topic that we covered? What are the factors to be considered in determining the extent of test of controls? How much test of controls do we need to do? So number one is control performance by the entity, frequency of control performance by the entity. Number two, length of time the auditor relies on the control's effectiveness throughout the year or just at the end of the year. What is the expected deviation of the control? Whatever evidence I've obtained, whether it is reliable and relevant or not. If not, you'll have to obtain more evidence, of course, you'll have to apply more test. Okay, and then finally information which I have got from testing the related controls. So all these factors are going to make you decide basically on the extent of test of controls. Very, very important topic. Okay, so test of controls, guys, we have covered nature and extent. Now the next point, again very important one, is timing. When are you going to test the controls? Okay, so let's read this, guys. Very simple. With respect to timing, I have given 3 4 points. It says test of controls for specific time or throughout the period for which reliance is intended. So if you are only concerned, if you just want to see whether controls with respect to inventory was it there as on 31st March, so you'll have to check only for that specific point of time. But you are concerned, you're worried whether this control on inventory was there throughout the period or not, so you'll have to check throughout the period. That's it. So test controls for either specific time or throughout the period for which reliance is obtained is intended. If I'm only concerned with obtaining reliance whether the control was working as on 31st March, I will do testing on that specific time, for that specific time. If I'm concerned, if I want to obtain uh, you know information that whether the control was operating throughout or not, I want to have reliance for the entire period, so that means I will have to check throughout the period. That's it. So what is about the timing of testing of controls, either specific time or throughout the period. Okay, now let's read this. Audit evidence pertaining to a single point in time may suffice, such as testing controls over period and activities like physical inventory counting. So sometimes only by checking at the physical at the period end at a specific point of time, at a single point in time may suffice. For example, in case you want to do a physical verification as at the end of the financial year, so it's basically audit evidence pertaining to single point in time. However, if relying on a control over a period, if you want to rely whether the control was there throughout the period, test should provide evidence of its effectiveness at relevant times during the period. So you have to check a lot of times during the entire period. Okay, now you have to understand this. I mean, we are done with the concept of timing. Okay, simple words, it can be either at a specific time or throughout the period. But the testing of controls, guys, may also include monitoring the entity's controls throughout the period to ensure ongoing effectiveness. Now when I say timing, you also you might have, your test may include monitoring of the entity's controls. You remember monitoring, we learned that it is one of the important components of internal controls, right? So you may test whether monitoring of internal controls is done throughout the period to ensure whether the controls are effective or not. If monitoring component is not there, the controls might not be effective, guys. It might become outdated, so this can be checked. Okay, all right, so yes, we are done with the timing concept also. Okay, just remember two words, either point in time or throughout. Now one thing, guys, let's say I was the auditor of this company in the previous year. Last year also I did it. And last year when I was doing the audit, of course, I would have assessed their internal controls. So can I use that understanding? Can I use the results of that test in the current audit? So the point says considerations for using previous audit evidence of control effectiveness. Can I use the previous audit evidence of controls effectiveness in the current year audit? So let's read the point. It says, guys, yeah, I can use, okay, so but there are certain considerations for using previous audit evidence of control effectiveness. Again, can be an important question. So what are the considerations? Can I use, let me repeat this again, can I use the previous report? Last year also I had done my audit. Can I use the previous audit evidence, okay, with respect to the internal controls effectiveness in the current year? If yes, what are the considerations? So number one, effectiveness of internal control elements. What are the internal control elements, guys? The components basically. So you have to see the effectiveness of internal control elements, like what, like you have to see that whether the control environment is still there. You have to see the monitoring of controls. You have to see the risk assessment process. Okay, so if you know um the three components that we have just covered, I mean we have five components, but you have to see basically if these components are there. I mean these are important components. Control environment is basically what, the foundation, okay. the How serious the management is with respect to internal controls, the attitude of management towards internal controls. And risk assessment process, I told you whether management has a system of risk management process or not, whether they have this ongoing system of monitoring the controls. So you have to see if these elements are effective. If these elements are very effective last year, you might think of using previous audit evidence in the current year, okay. But if these things are not effective, these are very crucial things, probably you might have to check all the controls again this year maybe, okay. Then risk from control characteristics. Next point is, if they have more of manual and automated controls, you only tell me. If they have most of the controls, if they have things are automated, so probably then the extent of checking in this current year would be less. You might rely on the previous audit report also. So the risk arising from the characteristics of control, including whether it is manual or automated. So what kind of risk arises from the control? See, no control is 100% foolproof, right? So you'll also have to consider the risk that arises from the controls. All right. Then effectiveness of general IT controls. Now, guys, you don't know about this yet. Uh, there is something called as general IT controls. There is something called as application and control. I did show you here, right? Controls in automated environment. I'll just give you an idea. What is ITGC? What is general IT controls? General IT control means controls which is throughout the system. I mean, let's say if upon logging in to the system, you need to give user ID and password. It's a general IT system. However, application controls are controls with respect to specific applications. Like for example, if you have some specific controls on the software of Tally, if you have some specific controls on a particular software, then it is application control. Okay. So the point says effectiveness of general IT controls. If the general IT controls were good, then effectiveness and the application of the control. Okay. No, I think there's a mistake. Yeah, actually the heading should have been directly deviations. Anyways, effectiveness and application of control, I mean whether the controls were really followed by the entity or not, or whether deviations means when the controls are not followed. So nature and extent of deviations, if there are any changes in the personnel. When I say changes in the personnel, that means let's say last year the store manager was this person, now the person has changed. The person, Mr. X, who was the store manager last year, he was there in the organization since last 3 4 years. Let's say he has knowledge of the entire department, he was working very well, but now the person has changed. All of a sudden the person has been replaced, a new person has come. So in that case, maybe you would want to see whether he is doing the work properly or not, etc. So again, whether the controls are being followed or not. Okay, then we have certain more points, guys. Potential risk from lack of change in control. Potential risk from lack of change. A control was required to be changed, it was supposed to be updated, but then there is no change. So potential risk from lack of change in control. There was a change which was supposed to be done in the control, but they have not done it. Okay. Then risk of material misstatement and reliance on control. Of course, how much last year, let's say, guys, okay, last year there were a lot of misstatements. That means the controls were not good. So this year also probably you'll have to see that risk of material misstatement this year, and also to what extent you are relying on the controls. Okay, and accordingly you'll have to decide whether you can use the last year's audit evidence, or you'll have to basically do the checking, do the testing of controls again. And establishing continuing relevance, most important part. Okay, sir, I wish to use the audit evidence that I had obtained with respect to controls in the previous year. I want to use it this year. So first you'll have to see whether it is going to be relevant. Ensure establishing continuing relevance, obtaining audit evidence of significant changes in control since the previous audit. So let's say you have decided that, okay, I'm going to go with the previous audit evidence that I had obtained. But then if there are any changes in the control, you'll have to do the audit of the changes. It says obtain evidence of significant changes in control since the previous audit. Okay, so guys, a tough question. I should say it's a tough question, because again it will require you to remember the points. It says again, what is the point? Considerations for using previous audit evidence of control effectiveness. Okay, so the auditor shall consider the following. If you wish to use the previous audit findings or evidence with respect to control effectiveness, you have to consider these aspects. What are the aspects? Whether the control environment, not environment, control elements, or let's say components of internal control are effective or not. What is the risk from the controls that the company faces, whether it's more of manual or automated? How effective are their general IT controls? How often do they deviate from their controls? Oh, have they made the necessary changes in the control or not, which they were supposed to make? Okay, and if they have made changes in the controls, you will, of course, you will have to at least check the changes. You'll have to do the audit of the changes if you wish to rely on the previous audit evidence of control effectiveness. Okay, all right, done, guys. Now, so we have completed this considerations for using uh, audit evidence of the control effectiveness of the previous year. Okay, now we just have one more topic. You have to evaluate operating effectiveness of controls. Okay, so with respect to test of controls, see what all things we have covered. Majorly we have covered nature and extent of controls. I'll just summarize it, don't worry. Then we have covered timing, and then we have covered what if you wish to use the previous audit evidence of controls, what are the considerations, and now how are you going to evaluate the operating effectiveness of controls. Okay, so guys, you only tell me. Let's say you are doing the substantive process and then you find some misstatements. So does it mean that your controls are ineffective? What do you think, guys? Yes. Don't you think, guys? Okay, please understand it in this way, guys. If we are doing substantive procedure and we come across misstatements, so does this indicate, if we have detected any misstatements by doing substantive procedures, does it indicate that the controls are not operating effectively? Yes, that is why there are misstatements. Okay. However, guys, that doesn't mean that if you are doing substantive procedures and you don't find any misstatements, that doesn't mean the controls are effective. I mean, if you don't find any misstatements, doesn't mean that the controls are effective. Why? Because detection risk, it's not necessary that we find all misstatements. So in case you don't get any misstatements, don't assume that the controls are effective. Okay, so first 2 points, I'm repeating this again, guys. Let's say you're doing substantive procedures and you come across a misstatement. So will it indicate that the controls are not effective? Of course, yes, it might indicate. However, you did not come across misstatements. So does it mean that the internal controls are absolutely fine? They are perfect. They are great. The answer is no. Because please understand, guys, it might be the case that we are not able to find all misstatements, but that doesn't mean that your internal controls will be 100% effective. Okay, and then there is a point, deviations from intended controls, guys. Okay, now when you come across deviations, okay, what does it mean when you come across deviations? So if deviations from controls upon which the auditor intends to rely are detected, if you have found some deviations in the internal control, what is deviation? That means the controls were not working as uh, intended. Now the auditor will make specific inquiries. See, guys, let's say we are checking the payment vouchers. They told us that every voucher, every payment of in excess of 10,000 rupees, there is a signature of the authorized management competent authority. And now you're checking the payment vouchers. You found that in many payment vouchers exceeding rupees 10,000, the signatures were not there. So is it not a deviation? The answer is yes, it's a deviation. Now what is the thing that you are going to do. You are going to make inquiry. We are going to make specific inquiries to understand these matters. I mean, we are going to ask, hey, you were saying that all the payment vouchers are signed, but I can't see the signatures here. So you are going to make specific inquiries. Okay. Now, uh, you and when you make specific inquiries, you have to also determine that whatever test of controls you have tested so far, okay, the test of controls that have been performed provide an appropriate basis for reliance on the controls. Can you rely on the control or not? Whatever tests you have performed so far, can you rely on the control, or there is a need to do additional test of controls? Okay, so if there is deviation, guys, from intended controls, number one thing that you have to remember is you are going to make specific inquiries, and then you shall determine whether the test of controls that have been performed provide an appropriate basis for reliance on the controls. Then any additional test of controls are necessary, or the potential risk of misstatements needs to be addressed by using substantive procedures. So you will have to do more of substantive procedures also if you feel that the control was not working properly. Okay, again, last part, guys, how we are talking about evaluating the operating effectiveness of controls. Okay, what did I tell you? So let's say, guys, you are doing a substantive procedure, and then you come across a misstatement. So will this indicate that the controls are not proper? Yes, maybe yes. However, if you don't come across any misstatement, does it mean that the controls are super effective? The answer is no. The control, might not be very effective. No misstatement doesn't mean that the control are effective. Okay, and the third one is basically, guys, if you come across deviations from the intended controls, you are going to make specific inquiries, and then you shall determine that whatever test of controls you have done so far, whether you can place reliance on the controls, or you need to perform additional testing of controls, or you need to increase the extent of your substantive procedures. Okay, so this was all about test of controls, guys. Again, I'm just quickly going to revise it for you again. Okay, it's a revision session, again doing a revision. Okay, so first thing that you have to remember is nature and extent of test of controls. Under nature and extent of test of controls, what all things do we have to cover, guys? You have to understand that when I say nature and extent, inquiry alone will not give you sufficient appropriate audit evidence. You have to perform other audit procedures. Also, you'll have to see how the controls are used, applied, whether they have been applied consistently or not, who is responsible for the controls. If one control is dependent on the other control, you will also have to see the effectiveness of that indirect control. Okay, please note, inquiry alone is not going to give you sufficient, hence other audit procedures are also necessary, like reperformance, like uh, uh, you know observation, I told you, inspection, etc. But this is very important question, guys. Factors considered in determining the extent of test of controls, very very important question. So we have covered this. Then timing, I told you two things you have to remember, either at a point in time or throughout the period. Now, considerations for using previous audit evidence for control effectiveness, this again is a very important question. So please remember this topic here, factors, and this consideration, it would require a bit of retention. Okay, so be smart, focus more on these topics. And then it was basically about evaluating operating effectiveness of controls, right? So we have primarily four topics which we have covered with respect to test of controls. Now the last topic with respect to SA 330, what is the last topic? Substantive procedures, guys. We are going to cover substantive procedures. Now, in substantive procedures in our book, the content is not much. I mean, in the ICI book, they have little less of content, but then I have tried my best to incorporate other aspects also, because auditing pronouncements is also there for you, right? They have uploaded auditing pronouncements also in the ICI website, right? Board of Studies portal. So, and 330, SA 330 is very much in your course. So we'll understand some aspects about substantive procedures also. So first thing that you have to know about substantive procedure, let us quickly understand. You already know this classification. We have test of details, and we have substantive analytical procedures. And under test of details, you already know we have test of transactions, which is vouching, and we have verification also. What is vouching, guys? Vouching basically means verifying individual transaction, and verification means what? It means verifying the existence of assets or liabilities. So verification is basically with respect to balance sheet items, and vouching is testing of transactions. So you already know this classification, not very important for you. However, similar to this, if you can see, we had covered nature and extent of test of controls here. We had covered nature and extent of test of controls, right? Similar to this, guys, we are going to cover nature and extent of substantive procedure. So let's cover the nature and extent of substantive procedure. Very simple. It says, okay, guys, we have options here. How much substantive procedure you have to do? We have options. What are the options? Either you can only do substantive analytical procedures, because analytical procedure, if they are giving you sufficient appropriate audit evidence, you can just do that. I mean, analytical procedure anyways is an intelligent way of doing the audit. Or you might even do just test of details alone, you might just do vouching verification alone, or it may be a combination of these two. So substantive, we have the options, guys, either substantive analytical procedure alone, or test of details alone, or combination of both. Okay, however, you all know this, when will the extent of substantive procedures increase? If you do a test of controls and the results are not satisfactory, don't you think the nature, timing, and extent of our substantive audit procedures will increase? The answer is yes. So unsatisfactory results from test of controls may increase the substantive procedures. I hope you all are clear with this. Okay. Now, guys, do you remember in essay 315, I had taught you something called as significant risk? Can you tell me, guys, in the chat box, what is significant risk? What is significant risk? Yes, I did tell you. Let me just quickly take you back to the chart. I told you that once auditor identifies and assesses the risk of material misstatement, okay, once he identifies and assesses the risk of material misstatement, he has to prioritize. And yeah, yeah, Amrita, you're absolutely correct. Significant risk means risk which requires special attention of the auditor. Okay, so we covered about significant risk. Now, if there is a significant risk, do you remember on what uh, we covered certain factors to determine whether a risk could be a significant risk? I told you whether the risk is on account of fraud, if it involves complex transaction with related parties, transaction outside the normal course of business. We covered these points, right? Now, if you happen to come across these type of transactions, let's say, what will you do? What will you do? So the point says, I mean, the topic that we are in at the moment, it says substantive procedure responsive to significant risk. Very simple point, guys. You have to perform substantive procedures specifically tailored to address the identified significant risk. So if, let's say, I feel that there might be a fraud, it's a significant risk, so now I'm going to do substantive procedures to basically see actually if there is a fraud. I have to do substantive procedures specific to the address identified as significant risk. Very simple. Okay, now there are few more points, guys, in this standard, guys. Let's say substantive procedures towards the, for the transactions, or let's say related to financial statements closing process. Substantive procedure, let's say with respect to some disclosures also, we are not going to go into that detail, it's not there in your ICA material. However, with respect to timing of substantive procedure, this is also not there as such in your ICA material, but then it's a basic thing, right? Timing of substantive procedure, you remember we covered timing of test of controls. With respect to timing of test of controls, what did I tell you? Either at a single point in time or throughout, right? But in case of substantive procedures, guys, let's say if we have done some substantive procedures, okay, for the month of, we have checked sales for the month of, let's say, July, then what has to be done about the others, other transactions of sales? So we are going to learn about this timing of substantive procedure here. Okay, so substantive procedure, if you do at an interim date, not at the end of the year, but at somewhere in between. Let's say, you are the auditor of the company, and in the month of July uh, of this financial year, you went and you just check certain sales amount transactions. You have done substantive procedure at interim date. So now what has to be done? It says if you do it at an interim date, then options, you have certain options for covering the remaining period. What are the other options? Either you do substantive procedures combined with test of controls for the other period also. So for other months also, I would be doing some substantive procedures, or you can only do substantive procedures if you determine it to be sufficient. If you feel test of controls are good, then you can only resort to substantive procedures. So we have got two options, guys. Again, if you have done some substantive procedures at the interim period in the middle of the year, let's say, okay, then let's say once the financial year is over and all, you want to get more assurance, let's say, so you might check, you might go for further substantive procedures along with test of controls. But if you already have the knowledge of test of controls, if you feel they are effective, you might only resort to substantive procedure. That's it. Okay, and guys, timing of substantive procedure, again, response to unexpected misstatements. If there is some misstatements, okay, so evaluate and potentially modify the assessment of risk and planned procedure if unexpected misstatements are detected at an interim date. So if you come across some misstatements at an interim date, you might have to make certain revisions and extend your nature, time and extent of substantive procedure, because you feel that there might be more misstatements, so you'll have to accordingly plan your audit work. Okay, done. So not very important, but yes guys, with this, if you can see, we have completed essay 330, and there might be few direct questions asked from this standard, and it's a new standard. I mean, this was there in the CA final. We have been teaching this in the CA final, but then this has been newly incorporated in the intermediate level also. This standard was, I mean, the basic concepts of this standard, like what is test of controls, what is substantive procedure, I used to teach in the old course also, though this standard officially was not there in the old syllabus, but now they have formally incorporated it. But then again, the full standard is not there. Okay, so with this guys, we have completed essay 330 also. Now in this particular chapter, what we are left with is two topics. If you can see, one is essay 320 and the other one is the topic of audit in automated environment. All right, friends. So now let us start with the last standard of this chapter, which is essay 320, a easy standard. And 320 is on materiality. Materiality in planning as well as performing the audit. Okay, this is the last standard of our 300 series. We have already completed 300, which was on planning. We covered 315, identifying and assessing the risk of material misstatement. We just covered essay 330 also as to how we have to respond to the assess risk. And now the last standard from the 300 series, which is on materiality in planning and performing the audit. Okay, so what all things do we have to cover here? First, we'll just understand the basics of materiality, guys. We'll go through these basic concepts of materiality. Okay, so we have certain concepts here. 320, essay 320 defines information as material if its omission or misstatement could influence the economic decisions of users. So I've been telling you this from my regular lectures, in my regular lectures also, that guys, what is materiality? Something which would influence, the misstatement of which would influence the economic decisions of the user. Okay, now materiality is important to the auditor because if a material item is incorrect, if something which is material is incorrect, is misstated, then the financial statements will not be giving true and fair view. Okay, now what would amount to as material? It's a matter of professional judgment. The auditor's determination of materiality is a matter of professional judgment, and whether something would be material can depend on two things. Basically, it can be by the size of the misstatement, size of the item, or on the nature of the uh, item. Okay, so let's say the total of the balance sheet is 10 lakh rupees and inventory alone is 8 lakhs. So if any item in the inventory is misstated, of course it will be material. Why? Because out of 10 lakhs of the asset side, 8 lakhs is only inventory. But sometimes it's not just about the size which would make an item as material. It may be on the nature of the item also. Let's say in this company only, wherein the total of the assets is 10 lakhs and inventory is 8 lakhs, but what they have done is the director gave 5,000 rupee to his son as loan. Director gave 5,000 rupee as loan to his son. Now 5,000 might not be a very big amount. Okay, or let's say he gave 2,000 rupees only. Let's make the amount even smaller, but then it's a very important thing for the shareholders to know that the money that they have put in the business, the director has given it to his son for their personal usage. So this is something which requires disclosure. So as per AS 18, it's a related party transaction, right? Transaction with the director's son. So the disclosure of the same has to be made. Even though the amount is only 2,000 rupees, if the disclosure is not made, it would be a misstatement. So it is a material thing now. Okay. So this was just an example, guys. Okay. So in our regular lectures, we cover a lot of examples though, but I hope you have understood that materiality can be on the basis of the magnitude, the size of the transaction or item, or it can be on the basis of the nature of the item. Okay, all right. Now guys, whether something is material or not, I would determine materiality not considering the needs of individual users. Like for example, this company of mine, of which I am the auditor, they have taken a loan from the bank against their plant and machinery. So this bank would always be concerned about the assets of the company. On the other hand, the shareholders would be concerned whether the company is earning profits or not. Yes. So different needs, different users will have different needs, right? But then as an auditor, I need to determine materiality based on the needs of the common users, not, individual users. It says judgments about materiality are based on consideration of common financial information needs of users as a group and not specific individual users, right? Okay, so these are the basic things about materiality, guys. Okay, now what is the objective of auditor in this particular standard? Very small point. The objective of the auditor is to apply the concept of materiality appropriately in both planning as well as performing the audit. Okay, so we have to apply the concept of materiality while planning as well as performing the audit. Not very important. Okay, now let's start with the main standard, guys. Let's talk about the requirements of this standard. If you see, guys, we only have four requirements. Number one, you have to determine materiality. Two types of materiality. They determine materiality and performance materiality when planning the audit. So we have to basically find something called as materiality and also performance materiality. Okay, now what is the point? Let's understand. It says when establishing overall audit strategy. Remember in SA 300 I told you first is what we establish overall audit strategy. When establishing overall audit strategy, the auditor shall determine materiality for the financial statements as a whole. There would be two materiality levels: materiality for the financial statement as a whole and materiality for specific class of transaction, account balance, or disclosure. So again, guys, in very simple terms, if I say, okay, materiality can be of two types, I mean two levels. Materiality is what? For the financial statement as a whole, and it could be for specific class of transaction, account balance, or disclosure. Specific class of transaction, account balance, or disclosure. For example, now let's say I have set the materiality for the financial statements as a whole to be 5 lakhs. That simply means I would be checking all the transactions which is 5 lakhs and above. Other than that, I will not be checking. So this is, let's say, I'll be doing sampling rather. Okay, but then all transactions which are above 5 lakhs, I'll be checking. I'll be doing 100% checking of those transactions. But then, guys, sir, you told that related party transaction is an important thing, let's say, okay, and even if it is of 2,000 rupees, 5,000 rupees, it has to be disclosed in the financial statements, right? If you don't disclose a particular requirement, let's say it's an AS 18 requirement that related party transactions have to be disclosed, but if it is not disclosed, it leads to misstatement. It would amount to misstatement, right? So in that case, guys, what we can do is we can even set materiality for specific class of transaction, account balance, or disclosure. So let's say we set materiality for a specific transaction, or let's say related party transaction. We set it at, let's say, rupees 1,000. So all related party transactions above 1,000 will also be checked. Okay, the management will anyways give me the list, but I'll check them. Let's say. So what has happened here? I have set two levels of materiality: materiality for the financial statement as a whole, and materiality for specific class of transaction, account balance, and disclosure. But you have to always remember, guys, that the materiality level for which is set for specific class of transaction, account balance, or disclosure would be less than the materiality which is set for the financial statement as a whole. Else the purpose is only defeated, right? Let's say you keep this as 8 lakh rupees, then anyways, guys, you are checking all the transactions above 8 lakhs. So remember that when you keep materiality, when you determine materiality for the specific class of transactions, it has to be lower than the materiality for the financial statement as a whole. Okay, all right. Now, guys, what happens is, yeah. So this standard tells us that you have to determine materiality at two levels: at financial statement as a whole and for specific class of transaction. Okay. Now let's read the point further. It says the auditor shall also determine something called as performance materiality for the purpose of assessing risk of material misstatements and determining the nature, timing, and extent of further audit procedures. So we also have to determine performance materiality. Now, just to make you understand, guys, after setting this, we are also going to, for each level, we are going to have a performance materiality also. For this also, we are going to have performance materiality. Okay. Now, what is performance materiality? Performance materiality is basically a materiality level which is set below, the materiality for the financial statement as a whole, or let's say materiality for specific classes of transaction, account balance, or disclosures. We set it at a lower level. Why? In very simple terms, first let's read the definition. It's a complicated definition here, but you'll understand the logic very clearly, don't worry. In my regular class, perhaps we give almost more than an hour into this concept. Okay, So what is performance materiality? Performance materiality means, read it very carefully, very slowly. It means the amount or amounts set by the auditor. Who is going to set it? The auditor, at less than materiality for the financial statement as a whole. So we are going to set it at a lesser amount than the financial statement as a whole, or lesser than materiality for specific class of transaction, account balance, or disclosure. So we are going to set it at a lesser level. Okay. And uh, to reduce to an appropriately low level, the probability that aggregate of uncorrected and undetected misstatements in the financial statement exceed the materiality for the financial statements as a whole. So we want to reduce the probability that the aggregate of uncorrected misstatements and undetected misstatements should not exceed the materiality for the financial statement as a whole. Hence, we we determine something called as performance materiality. What are you saying? Nothing is going inside our head. Don't worry, don't worry. This is a technical definition. I'll take some time and I'll explain it to you. Okay. Now, what happens? Let's first understand this, guys. Mr. Auditor, this auditor, what does he do? When he's doing the audit, he basically is there to look for misstatements, right? And when he applies his procedure, of course, he would be able to detect some misstatements. And when I detect a misstatement, I'll ask management to correct it. So either they will correct it or they will not correct it. Okay, if they are corrected it, good enough. And there might be certain misstatements which I did not detect, guys, because that there is something called as detection risk, and I'm not doing 100% checking of the transactions, right? So some misstatements might not be detected. So what is going to happen now after my audit? What is the total misstatement, guys, remaining in the financial statement? What is the total misstatement that might be there in the financial statements, even though I have done the audit? So it would be basically the sum of uncorrected misstatements and undetected misstatements. Yes or no? It's just an estimation. So I have mentioned it as UCMS plus UDMS. It's not an accurate value, guys. UDMS, undetected, is just an estimation, right? Now, please understand again, what is performance materiality? I'm going back to the definition. Performance materiality means the amount or amounts set by the auditor at less than materiality for the financial statement as a whole to reduce to an appropriately low level. What? The probability that, read this very carefully, the probability that aggregate of uncorrected and undetected misstatements in the financial statement exceeds materiality for the financial statement as a whole. So you would not want this to exceed the materiality which you have set for the financial statement as a whole. Hence, what we do is, guys, we basically check for transactions below this financial statements materiality level also. If, let's say, I'll give you an example. Let's say there's a company and their transaction ranges from rupee 1 to rupees 50 lakhs. Okay, and you have set the materiality level as rupees, let's say, 5 lakh. So this simply means what? You have set the materiality for the financial statement level as 5 lakhs. So this means all the transactions above 5 lakhs, guys, you are going to do 100% checking, and the remaining transactions, it's not that you're going to ignore them, you're going to do a sampling. But then what happens is, guys, let's say some transaction which is very close to 5 lakhs, let's say 4,80,000, or let's say 3,20,000. Okay, let's say all these transactions, let's say there is a misstatement in this one. But then, because, sir, you have determined 5 lakhs as materiality, maybe you will not be checking this. And then let's say there is a misstatement in these two transactions. What happens now? The sum of these two goes above 5 lakhs, and collectively it becomes material, right? So as an auditor, what we do is, even though we have set materiality as 5 lakhs, just as a safety cushion, we would be checking few more transactions close to 5 lakhs. I mean, we would be when we actually do the audit, we would consider something called as performance materiality. Performance materiality is a level which is set below the financial statements materiality level. Okay, why? So that aggregate, again, read the line, aggregate of undetected and uncorrected misstatements do not exceed the materiality for the financial statements as a whole. So generally, how it happens, guys, what we do is, we set the performance materiality maybe at, let's say, 80% of this materiality, or let's say 90%, 60%. It is upon the auditor. It's a matter of his professional judgment. Okay. So I hope you are clear on this. Why do we have something? What is performance materiality? Let us read the line again. Performance materiality means the amount or amounts set by the auditor at less than materiality for the financial statement as a whole. So in my example, materiality for the financial statement as a whole was 5 lakhs. So let's say I have set the performance materiality at 80%. Okay, so it's set at a lesser amount than the financial materiality for the financial statement as a whole. Why do we even have something called as performance materiality? To reduce to an appropriately low level the chances that aggregate of uncorrected and undetected misstatements exceed the materiality for the financial statement as a whole. We want to reduce this probability. Hence, we are going to check few extra things in our audit. This is called as performance materiality. Sir, can performance materiality be there for individual transactions also? Yes. That is why if you read the line, if applicable, performance materiality also refers to the amount or amount set by the auditor at less than materiality level or levels for particular class of transaction, account balance and disclosure. So that is why we can have multiple performance materiality also. Okay, I hope this is clear to you. Now, if this is clear, guys, we are not left with much in the standard because, okay, the main topic is still left, but this was basic, wherein we take a lot of time. I told you in my regular lectures just to explain performance materiality, guys, almost 1 hour, 1.5 hours I take. Okay, now, guys, the most important question, guys, from this standard is how are you going to determine the materiality? Okay, so guys, we generally use some benchmarks. We use certain benchmarks in determining materiality for the financial statement as a whole. Okay, what could be the benchmark? Sir, it could be anything. I mean, we apply a percentage of to net profits. It can be percentage of the turnover. It can be percentage of some expenses. It can be anything. Okay, it can be any benchmark. So what happens is, determining materiality involves, number one, it's a matter of professional judgment, and please be very careful. It says a percentage is often applied to a chosen benchmark. A percentage is often applied. So what could be the percentage? Sir, it can be, let's say, 5% of a benchmark is net profit. It can be, sir, 1%, let's say, of um, total assets. Sir, it can be 0.5% of the turnover. So these are benchmarks, guys, and a percentage is often applied. So always remember, guys, when I teach you about benchmarks, please remember percentage will be applied to a benchmark. And now the most important question from this chapter: what factors will affect the identification of appropriate benchmark? Now the question comes arises as to how are you going to select that benchmark. Now let's say I'm just going to give you a very simple example, guys. Let's say the company is a new company. They are still in the gestation period. They have not yet started earning profits. They are having losses. For the first 4 or 5 years, they will be having losses because they are just incurring expenditure and all for the capital, plant machinery, whatever they're creating, let's say. Now, in this case, it's not going to be wise if I take net profits as a benchmark, right? So, different scenarios, we have to take different benchmarks. So, how will you choose the appropriate benchmark? It says factors that affect the identification of appropriate benchmark. Number one, what are the factors? Number one, your benchmark should be element of the financial statement. So, I told you it can be net profit, it can be turnover, it can be total assets, okay? And the item, the item that you're choosing as your benchmark, it says item on which attention of the users of financial statement of the entity tends to be focused, wherein the users as a group are more focused. You have to choose that as a benchmark. Okay, you also have to consider the nature of the entity and where it is in its life cycle, whether it is in the initial stages, in the introductory stages, or is it in the maturity stage, or is it in the decline stage. So you must have read about the life cycle in strategic management as well, right? So you have to consider that also, because if the company, if the product is in very early stages, you can't consider profit as a uh, you know a benchmark. If let's say this it's in a declining stage, when the sales, when the market is almost uh, going down, you can't take the turnover probably as the benchmark. So it is a matter of professional judgment, but then you also have to understand where exactly the entity is in its life cycle. Then the entity's ownership structure also you have to consider, whether it is the structure is mainly, whether it consists of equity or it's a mix of equity and debt. All these things you have to consider. And also you will have to consider the volatility of the benchmark. I mean, see, guys, we can't consider advertisement expense to be a benchmark, that I am going to consider materiality on the basis of advertisement expense. Advertisement expense is very discretionary. This year it may be 5 lakhs, next year it may be 30 lakhs. So we can't consider something which is very volatile to be a benchmark. Okay, so what are the factors that will help you in choosing the benchmark? Number one, guys, it has to be an element of financial statement. Second, choose that benchmark wherein the users are more focused. Third is you also have to consider the nature of entity, where the entity is in its life cycle, the ownership structure, how the entity is financed, whether it has more of equity or debt in its capital, and also the last part is the volatility of the benchmark. So this was the most important part in the entire standard, guys. And with this, almost our standard is going to be over. So once this is done, you have set a materiality level, guys. Let's say, okay, and we set the materiality at the planning level. But then when you actually start doing the audit, you see that there is a lot of the controls are not good, there are a lot of misstatements, etc. Okay, then you might have to even change the materiality level that you had initially decided upon. And trust me, guys, this is going to be really dangerous situation. Okay, because you have already tested so many things, you have checked, you have done substantive procedure. Again, if you revise your materiality level, you will again have to test a lot more things, right? So revision as audit progresses, it says the auditor should revise the materiality level for financial statements as a whole, or for the ABCD level, assertion level, in the event of becoming aware of information during the audit that would have caused the auditor to have determined different materiality levels initially. So had you known about this thing initially, you would have set a different materiality level altogether. So there might be chances that you might have to revise your materiality level. It's going to be a dangerous situation. Okay, all right. So last part of the standard, guys, sir, we have to even document something. Yes, what is it that we have to document as a part of the standard? We have to document the materiality that we have set for the entire financial statement, the materiality, if at all, we have set for individual class of transactions, account balances, or disclosures. You also have to document performance materiality for each of them. And if there is any change in either point one, two, or three, then also you'll have to document in the changes. Fine. So with this, guys, 320 is over. We have covered it quickly. I hope you have the concept specifically with respect to performance mortality is clear to everyone. Yes or no, guys? Is it all good? Please write in the chat box. Should I move with the next topic? Yes, okay. All right. So, chapter 3, we are almost towards the end. The last topic that we have to cover is audit in automated environment. Very small topic, but very easy and a scoring one. We have limited set of questions to cover from this aspect. Audit in automated environment, one of my favorites. Okay. So, what does automated environment mean, guys? In very simple terms, if I tell you, these days what has happened is our clients have started using the systems, right? And most of the business transactions processes that they do is in the system. So we are going to learn here things with respect to auditing in an automated environment. So let's see what all things do we have to cover. Some basic points we are going to cover about automated environment. Then what could be the risk if uh, the entire system is automated. Then we are going to learn about certain controls. Then how will you do testing in the automated environment? Then concept of data analytics, and finally audit trails. Okay, so what is audit in automated environment? In basics, guys, we have three things to cover. I'm going to teach you first what is the meaning of automated environment, what are the features of automated environment, and as an auditor, what things you should consider when you are wanting to understand the environment, automated environment of your client. Of course, you need to understand your entity, client's entity, and its environment, right? So you need to know about their systems also. Okay, so very important question we have to cover. Now, what is the meaning of automated environment, guys? It simply means business environment where the processes or operations or accounting, any process, marketing, let's say they are doing sales, okay, accounting, and even the decisions also are taken by the computers, by the systems. So decisions also, let's say, guys, uh, I happen to be a manager of a bank, okay, and you have come to me to get a loan of 2 crore rupees. So we have a software, okay, and I will put some details. I will ask you for your income of the last 3 years. I'll put the details, and then I'll press the button, and the system is going to tell me whether you are eligible for the loan or not. So system also helps in decision making. So what is automated environment? It's a business environment where the process, where the operations, even the accounting, even decision making is taken care by the systems. That means information systems or information technology. Okay, now if our client is using technology, guys, if they are using information systems for their different businesses, different processes, etc., what will be the features, what would be the benefits? See the point. So if the client uses IT systems, guys, it will help them to have the business operations would be much faster. Imagine like a company like Amazon, right, or Flipkart, the number of orders they receive in a particular point of time, and if imagine if it was manual, they would have not been able to process so many orders at one point of time. But then because of technology, what happens, the operations becomes faster. Also there is accuracy in data processing, the sales transaction, the amount, everything would be automated. So it never happens like when you are placing an order on Amazon and they are charging less money. Okay, I mean, the order amount is, you can see 5 items but they're only billing you for 3 items. It is not going to be there. So chances of errors, accuracy is going to be high, chances of errors is going to be less. They would be able to process large volume of data. Imagine number of orders at one point of time in Amazon. Large volumes of data is only they are able to process because of technology. Okay, integration between business operations. Now, in the traditional times when there were no systems, what used to happen, there was a problem in coordinating. Let's say the sales team has done a sale, okay, but then the logistics team is yet to deliver the goods, and the customer is now shouting. But then when the things are in systems, everything is integrated, right? The moment the sales happen, the logistics department is updated, they pick up the goods and all, and the consignment number, the courier number, the delivery challan number, etc., is updated to the customer also. So everything is now integrated. I mean, when you order goods, okay, from any website, okay, let's say my website edu launch, okay, you have purchased a class, but then I don't have my own delivery system, right? So we use Blue Dart or delivery courier, but then you do get a message that your books are dispatched, or maybe the books is arriving today. You do get a message. So all these things are possible, integration is possible because of the systems. Okay, and because of the systems we have better security and controls, less prone to human errors. Of course, manual things, when there is no manual intervention, or the chances of human errors is less. It can provide you with the latest information, guys. Let's say in traditional systems, uh, on one particular day, let's say it's almost 12 p.m., okay, and I'm the manager. I ask my person, I ask my staff, hey, up until now from 9 a.m. to 12 p.m., in last 3 hours, how much sales have been done? You will have to calculate, you'll have to see. But then if things are automated, you can tell the data in real time. You can just say, oh sir, by now in last 3 hours we have achieved sales of 3 lakh rupees, let's say. So information, it gives you latest information. And connectivity and network capability is also there. Connectivity and network capability in the sense, let's say, guys, if my system is connected through technology, I'm traveling, I can just very well see it in my mobile phone. I can see all the information in my mobile phone also, right? I can see it from anywhere, anytime, if it is cloud based also. All right, so these are some basic features of the automated environment, and a good question that may be asked. Okay, all right. But as an auditor, guys, it's very important for us to understand the environment of our client. We need to understand, in 315 we did cover, right? You need to understand the entity and its environment. So now if they are using automated systems, we have to still understand it, right? So that is why this topic of audit in automated environment is along with the 300 series of our standards. Okay, so understanding an automated environment, so very important question. How, what things will you check, or try to obtain an understanding of? So first thing is, you need to know what information systems they are using, whether they are using uh, normal tally software, or whether they are maintaining accounts in Excel, or they are using complex or sophisticated systems like ERP, whether they are using SAP, etc. Okay, and if they are using technology, for what purpose are they using? Is it for financial purpose or non-financial purpose? Are they using technology only for wishing their customers happy birthday, or are they even using technology for processing the financials, okay, of the company, the accounting part also? So you have to be very clear on that. Okay, third, where is the system located? I mean, their server, is it located with them in their office, or is it somewhere in the cloud? So you need to know about the location of the IT system, whether it is local or global. And if they are using a particular software application, let's say they say that, sir, we are using SAP, or let's say we are using Tally. So you need to be aware which version of Tally are they using. Are they using still 7.2, or whether you're using 9, or they're using Tally Prime? You need to know all these things. Okay. And let's say they say that, sir, we are using this software. You need to understand whether the software that they're using for accounting or for, let's say, billing, whether they have bought it, it's a ready-made software, or is it customized. Okay, now Tally is a ready-made software, it's a packaged software. Some companies might use their own in-house developed accounting software. So you have to be clear on that also, whether they are using packaged software or is it an in-house software. Okay. Now, with respect to IT, what aspects have they outsourced? Sometimes in your offices also, you must have seen that many things with respect to IT, the systems is outsourced. If something goes wrong in the system, there is a maintenance guy, we call him, and he comes and he does the maintenance work. So what aspects of IT has been outsourced? Who are the key persons who takes care of the technology? Who is the chief information officer? Who is the chief information security officer? Who is the chief technology officer? You should be knowing the hierarchy also of the security, or let's say technology officers, okay, in the company. So this is all about understanding of automated environment, and these are some points, guys, that the auditor should consider. These are certain points that the auditor should consider to obtain understanding of the company's automated environment. Very, very important question. Okay, please mark it as important. All right. So with this, the basics part, guys, is over. And in basics, we read the meaning. We have covered the features, and features and understanding of automated environment. Both are important topics. Okay. No doubt, the company will have these many benefits if they use systems, right? But then, guys, it will also come with certain risk. When you use systems, it will have certain risk also. See, I mean, these days we see so many scams with respect to UPI and all happening, right? A lot of people, they and they perpetrate, basically they indulge in scams in different ways, right? And why this has happened? Because people can, get into your WhatsApp and hack your WhatsApp, basically, and get your bank account details and transfer money to their account, or maybe make you click some unwanted links and then you lose out your money. All this is happening. Why? Because, see, earlier when technology was not there, people would not break into the banks and steal money, right? That the probability is less. But because of technology, there are certain risks also. So now we are going to understand. No doubt there are the features, but then there are certain risks also in automated environment. Okay, so what are the risks? So first we are going to learn about what could be the different risk from the use of IT, and then we are going to read about the impact of this IT related risk. And after covering the risk, of course, we have risk, right? And that is why we have to have controls also. The entity should have necessary controls. So immediately after the topic of risk, we are going to cover the topic of controls. Okay, so what are the risks from the use of IT? There could be various risks, guys. Number one, inaccurate processing of data. Let's say we have our systems, but it doesn't process the data accurately. I mean, when I write 2 plus 2, it gives me 3. So that means the processing is not correct. Number one. Second, unauthorized. Okay. Okay. So let's see the second point. Unauthorized changes to the data. Somebody has made changes to my data. Let's say I have my details in the bank, right? I have an account in Union Bank, let's say. So they would be having my master data, my name, my PAN number, etc., and all the transactions that I did. But some hacker hacked into the website and he has changed the data. So this is called as unauthorized changes to the data. That means the integrity of my data is now compromised. Okay. With respect to change, I think we have one more point, guys. Yeah, this one is unauthorized change to data, and this one is unauthorized change to system or programs. I mean, the hacker makes changes to the settings of the system. Okay, there is a difference between point 2 and point 5. Both are unauthorized changes. One is to the data and one is to the settings of the system. Now, in very simple language, if I say, let's say somebody hacks your phone and he gets into your WhatsApp, okay, and now he's deleting your text, or he's sending some text to others, etc. This is changing in the data, but then he changes the settings of your WhatsApp. Let's say he changes your display picture, he changes your last scene, and whether you want to have the read receipts or not, he changes the settings of that. So this is also what unauthorized changes to the system or programs. Okay, one more point with respect to change, guys. We were supposed to make changes. Let's say we are the organization, and last week the rate of GST was changed. So now we have to make this change in our software also, in our accounting software, but we have failed to do so. So this also is a risk. Now all the accounting transaction, all the billing which will be made will be incorrect. So it says failure to make necessary changes to the systems or programs. So point 2, point 2, point 6, and point 5 are all with respect to changes. Okay, then let's say guys, there is lack of adequate segregation of duties. You have given responsibility to one person, there is no segregation of duties, then it can be a very dangerous, it's a very big risk. Okay, first point was inaccurate processing of data, and then there is some changes in data. What if the hacker deletes all your data? This loss of data, it's a loss of data. Forget about the changes, he completely deletes, wipes off all your data, it's a loss of data. And let's say guys, you are an authorized user who use the system, you are an employee of the company. Always remember that excess rights must only be limited to your job responsibilities. You should not be given excess rights. If a person is given more access or privileges than required, it is always a danger. Remember guys, more than the hackers, the internal employees are biggest perpetrators. Statistics shows, history shows that perpetrators, the main perpetrators, the one who create havoc in the company, the one who perpetrate into the systems, mostly are employees. Okay, employees are even more dangerous, so we have to have good controls with respect to employees. Ensure that you don't give them excess beyond requirement. Okay, so very important question, this also has been asked in the exam. What are the risks that can arise from the use of IT? So 7-8 points you have to remember. Okay, now what would be the impact of these IT related risks, guys? So of course it will have an impact on the substantive procedures, on your controls, on the reporting also. So what would be the impact on substantive procedures, guys? Now you will not be able to rely on the data obtained from the systems. So if you know that, okay, your integrity has been compromised, that means the system's integrity has been compromised, somebody has made unauthorized data change, somebody has made some unauthorized changes in the software. So in that case, what will happen? You will not be able to rely on the data generated by the system, so it is impacting your substantive procedure, right? And maybe you would now need more audit evidence. Sir, what would be the impact on controls? Sir, you cannot rely on automated controls anymore. Okay, and probably because you can't rely on controls, uh, even though you had controls, hacker has hacked in, you have given more access rights to the employees, you will not be able to rely on controls, and then you'll have to resort to more of substantive procedures. What could be the impact on reporting? Guys, you might have to communicate about the issue to the TCWG, and if let's say even after doing substantive audit procedures, more of substantive audit procedures, still you are not able to get sufficient appropriate audit evidence, you don't have evidence with respect to the truth and fairness of the financial statement, then you are going to give a modified auditor's opinion. Okay, so not very important, but then yes, of course guys, if there is a risk from the use of IT, these are the impact that will happen in our audit. So it will impact our substantive procedures, there will be an impact on the controls also, and there might be an ultimate impact on the reporting part as well. Okay, done. So now we have covered the risk. Okay, now let's cover a very important topic, another important topic, which is controls in automated environment. So the next topic that we have to do is, what are the different controls in automated environment? Guys, the different controls in automated environment, we have three different controls. The three different controls are general IT controls, then we have application controls, and then we have something called as IT dependent controls. So I'm just going to give you an overview first of the three controls: general IT controls, application controls, and IT dependent controls. So what is general IT controls? These are guys controls, these are policies and procedures that relate to many applications. It is not specific to one application, and they support the effective functioning of the application control. Okay, now for example, when you switch on your laptops, very simple example, when you switch on your laptops or when you have to unlock your phone, we have this passcode, we have the biometric, we have the password. These are general IT controls. It is safeguarding lot of your applications. Like when I have a password on my phone, it is safeguarding my photos, it is safeguarding my WhatsApp messages, it is safeguarding, let's say I have some bank apps also, so it is safeguarding a lot of applications, right? So these are called as general IT controls. But then guys, I might also have specific controls with respect to application. For example, I have one trading application, okay, and to use that, first I need to unlock my phone. That is general IT control. But to use the trading application, I have to log in again. It uses my biometric, and then only I can trade. So this is specific to one application. I call it as application control. I can have password only for my WhatsApp also. That will be application control. Okay, so what is application control? Application control, let's read the meaning, are specific controls. Please remember the keyword. Application controls are what? Specific controls which is unique to each application. It may be order processing application, it may be your WhatsApp, it may be the trading application which I told you. And these controls, guys, very important, will be embedded in the application itself. Now WhatsApp only gives you the feature to have password on for the WhatsApp. Okay, so they are embedded in the IT applications, they are embedded in the application only, and they help in ensuring accuracy, confidentiality, completeness, etc. So please remember, general IT controls are general, okay, and application controls are specific controls which is unique to each application. Okay, what could be the examples, guys? Okay, there are certain examples of application control. Let me just make you go through this. Okay, now let's say validation of input data, mandatory data fields, limit checks, reasonableness check. These are examples of application control. Probably you'll not be able to understand the meaning, so I'll tell you the meaning of each of them in brief. It's not there in detail in our ICA material also, but then, because I told you this chapter is my favorite, I have an expertise in teaching IT related concepts. I'm a certified information systems auditor also. I have experience in this audit also, IT audits, and also I can, I mean, teach you these concepts very well. But then I'll, it's a revision lecture, so I'll stick to that. Okay, not be as detailed as the regular lectures. So what is validation of input data? Okay, now let's say, guys, I'll put it in this way. You are filing your exam form, let's say, or you're filing any form in on the internet, on the online form, okay, and then there is a phone number, and then you only write 8 digits there, and then you press the submit button. The system will immediately prompt you that there is an error. Why? Because they will, validation has not happened. They know that, okay, mobile number, there has to be 10 digits. So if you write 8 and then press submit, it will immediately prompt that there is an error. Rectify it and then only you submit again. So this is validation of input data. So this is an inbuilt control, right? I mean, any application wherein you are supposed to write phone number and you write 8 characters, it might not accept. Like for example, in Tally, you must be familiar with Tally. Let's say I'm creating a company and they're asking me the PAN number. If I write only 4 digits, it will immediately prompt me that there is an error. So what has happened? Tally itself has a control to check the validation, to basically validate whatever data we have inputted. Okay. Now, sometimes you will see that in some forms that you fill online, there is a star mark. You ignore that and then you press the submit button. It will not, the form will not be submitted. Why? Because they have a control that this field is mandatory. You have to mandatorily give it. Okay, this is again an application control. Next is limit check. Now limit check is what, guys? In very simple terms, let's say if I say uh, there's a payroll processing software, okay, and in this payroll software the employees are only required to feed in the number of hours they have worked, and on the basis of number of hours they have worked, the rate per hour is there and the calculation is done. So our company's policy is that no person can work for more than 80, let's say 8 hours a day, and we have this 5-day working system from Monday to Friday. Now, after the end of the week, let's say I am filling my working hours and I feel, let's say 80, or let's say I feel 60. Should the system accept it? No, because maximum an employee of this company can work for how many hours? 8 hours a day into 5 days a week, 40. So the number cannot go beyond 40. So the system will immediately prompt that there is an error. Maybe you were wanting more salary, so you fed 50 hours, but it will not take. It is not going to take anywhere more than 40. So this is limit check. Then reasonableness check. What is reasonableness check? Reasonableness check basically compares two fields. Okay. Now, just for the sake of example, let's say you're filling an online form. Okay. And then in the name column, you write Rahul. My name is Rahul. Let's say Rahul. And then there is a declaration towards the end. I Rahul, the name Rahul should come. I Rahul declare that the above information true and correct. And then there is a signature. But then what you do is in the name field on the top, you write Rahul, and then declaration, you write Rohit. Both are correct. I mean, because you are supposed to write alphabets, you are supposed to write name, but considering the entire form, is it correct? Answer is no. Both of them should match, right? So reasonableness check checks basically the relationship between two fields. The relationship that, okay, name Rohit, which has come earlier, should come in the declaration part also. So this is reasonableness check. So these are certain examples, guys, of application control. Remember, application controls will be embedded in the main in the software itself. Okay. And what is IT dependent controls, guys? IT dependent controls. IT dependent controls, let's read the meaning first. These are processes that are manually performed by individuals but rely on computer generated information. Okay, IT dependent controls. Remember, these are manual controls. These are manual controls, but it is very much dependent on the computer generated information. Hence we call it as IT dependent controls. Just for the sake of example, let's say guys, you want to have an access to a list, let's say, of users who have not logged into the system for last 90 days. Okay, it says a system generated report list users that have not accessed the system within the last 90 days. So there is a list. You took the list out from the system. Oh, these users have not accessed since last 90 days. Now, the internal control may require the administrator to review such report and disable certain users whose accounts have not been accessed. So I took the report from the system. Now I'm manually disabling these users because these users are not very, you know, the frequency of them accessing is not high, so I'm disabling them, let's say. So what I have done here is I took the list out from the system and now I'm manually disabling them. I told you, see, it's useless to give access to people, just like this, right? So we have to restrict our usage. So people who are not regular in accessing the systems, let's just block their passwords, or let's just temporarily block their password, etc. So we are disabling the users. Okay, now what has happened, I have taken the report from the system and I'm manually disabling them. So it's a IT dependent control. Okay, that's it. So let's say I have to review my debtors. I will take the list out from the system, and then I'm asking the debtors, I'm calling them, I'm following up for the payments and all. So again, it's what? IT dependent control. I took the list from the system and then I'm following some manual procedure. So it is IT dependent control. Okay, so I hope guys, the three controls, general IT controls, application controls, and IT dependent controls is clear to you. Okay, now just for your understanding, the general IT controls, I told you, it's general controls. It is not specific to one application. These are controls which will be there throughout the organization, right? So controls with respect to our data center. Data center is a place where all the servers are kept. Okay, so you would want your data center to be safe, right? You would want your data center to be protected, where all the servers are kept. You would not want any unwanted person to go inside your data center. You would also want to keep backups of all your servers, right? So all these data center controls will be a part of general IT controls. Program change, let's say, if you want to change the settings of Windows software, the operating software. Okay, it's not related to one application. Windows is your OS, right? So we have to have controls over that also. No, I mean, random person should not be allowed to make changes to the OS. So we have program control. We have access security. I mean, who is going to have access, what level of access to the systems? Again, it's a general IT control. The system administrator will decide upon this. Okay, and then we have application. See, in this organization, what all applications do we have to buy? Should we discard the unwanted applications or not? It's a part of general IT control. You might think, sir, we are talking about application, but no, decision as to which application has to be purchased, decision as to which application has to be discarded, decision as to what level of maintenance we need for the application, it's a general part. It's for all the applications, that's or maybe 5 applications. Okay, this application we have to maintain this way, this application we have to maintain this way. So it's a general aspect. Okay, so these are general IT controls. Though in our regular sessions, guys, we discuss all the data controls, all the controls in detail, but for the timing, it's a revision session, I'm not going into the details. Okay, so we have 3 levels of controls in automated environment: general IT controls, we have application controls, and we have IT dependent controls. I hope you have understood this. Okay, now we have understood the risk in automated environment, we have covered the controls also in automated environment. Now let's understand about testing in automated environment, guys. How are we going to test things in automated environment? So what are the common methods of testing? Very simple. Either, guys, you can use walkthrough. Walkthrough is basically a combination of inquiry, observation, inspection. What does it mean? I mean, you would want to walk through the entire process and understand the process. You are testing the controls. Okay, it says testing in automated environment. So how can you test? It says to obtain an understanding of how the transaction is processed in an automated environment. So let's say I'm doing the audit of an e-commerce company. So I would want to understand how the sales process is done. So I would ask them to make me walk through the entire process. So the first thing is order comes and this is how it happens. Then the order is confirmed and then the goods are dispatched. Then the invoice is sent. All these things I will ask them. So walkthrough is basically what? Obtain an understanding of how the entire transaction is processed in the automated environment. So it would include inquiry, it would include observation, inspection, etc. Okay, then I can just observe. Okay, let's say how a user processes a transaction. I can just observe, oh, This is how you dispatch your goods. Okay, so I can just observe, I can inspect certain documents, I can inspect, let's say, uh, the configuration which is defined in the system. What is configuration, guys? The settings of the system. The settings of the system I can inspect. I can inspect the system logs. Logs is basically the records, right? Who made the changes in the software. We can have logs, right? Do you remember the concept of audit trails? Also, audit trails is something which you must have covered in company law also. It has been made mandatory, like for the companies. So audit trails, they are logs. Okay, logs means you can inspect those logs to see if there are any changes which was made, etc. And you can also do reperformance, like applying the formula, business rules, etc. You can do a reperformance. 2 plus 2 answer is coming as 4. Oh, that means the system is correct. We can do such reperformances as well. Okay, so these are the common testing methods: observation, inspection, reperformance, and walkthrough. Walkthrough means having a detailed understanding of the entire process. So this is how you can test the automated environment. Okay, now with this, guys, the basics of automated environment, I mean the major concepts with respect to automated environment, we covered the basics. We have covered the different risk in automated environment, controls in automated environment, testing in automated environment. We have covered them in detail. If you want to understand this in more detail, we already have a video on audit of automated environment on YouTube. Okay, and this was basically pertaining to the old syllabus, so you can still refer to that video. Okay, anyways, two more topics we have to do, very small topics. It is with respect to data analytics. Now, guys, what happens is, so up until now, the 4 points which we had covered was from the perspective that, let's say, our clients are using IT environment, but then you as an auditor can also use systems to do analysis of the data. I mean, what has happened of late is, because of technology, the volumes of data which our clients are generating is humongous. It's huge. Okay, and imagine, I mean, you are doing the audit of Amazon and you want to check the sales and you have to do sampling. Will you be able to do that manually? It's not possible. So you have to do a very detailed analysis of the data. We call it as data analytics. Data analytics is a term wherein we analyze very big, huge amounts of data, maybe a big data also. We call it as big data. So that data analytics cannot be done manually. So we have to use certain technologies and tools. So what is data analytics? Let's understand. We have to cover two things only. We are going to first cover the meaning, and for us as auditors, where is the concept of data analytics we can use. So we are going to learn about the application part. So let's understand the meaning, guys. What is data analytics? It is a combination of tools, techniques, processes that are used to tackle vast amounts of data, electronic data, to obtain meaningful information. It is called data analytics. You are going to analyze vast amount of data, which is not possible without technology. Uh, Imagine analyzing the sales of Walmart. Almost at one point of time, it does millions amount of sale. It has stores across the entire America and in some European countries as well. So imagine the amount of sales they do in one particular point of time. So it's not possible to analyze the sales manually. So we use certain tools, techniques, processes to analyze this huge volume of data, and this concept is called as data analytics. So sir, as an auditor, how is it going to be helpful for us? So we have the applications. Okay, so data analytics, number one, will be helpful for you to pick up samples. I mean, generally what we do is we have certain softwares, guys. Okay, we can use the CAAT tools, computer assisted auditing techniques. We can use those tools. Even Excel also we can use to do the sampling. Okay, so we can do some bit of analytics of the data in Excel also. So we have selection of audit samples. You can see whether the data is complete or not using data analytics. Sir, how? Sir, let's say they give you a detail of the debtors, and you can match the total of the debtors with what is reflecting in the financial statement. So you'll get to know whether they have given the list of the entire debtors, or is it something is missing. You can recompute also the balances. You can do some recalculation of mathematical calculations. Like, of course, in Excel, can't we do calculations? Can't we check the depreciation value again? Can we recalculate it ourselves? Yes, we can do. We can also do journal analysis of the journal entries using the softwares, guys. Okay, and this would be required in specifically if there is a fraud. I mean, in cases of fraud, as per SA 240 is now no longer in your syllabus, but as if there is a fraud and all, you might have to analyze the journal entries. So fraud investigation, all these things you can use data analytics for. Okay, so the major thing is what sampling should come first. You can check whether the data is complete, you can recompute, you can recalculate, you can investigate for fraud, you can see the fluctuations if there is any huge fluctuations, all these things you can see. Okay, all right, so this is how data analytics is important for us, the auditors. Okay, and finally the last topic of the entire chapter 3, it is audit trails, guys. Okay, now what is audit trail? The concept, I mean, as I mentioned, you must have covered this in your company law also. These days all the companies are also required to maintain systems which has the mandatory feature of audit trail. Audit trail is nothing but logs. Okay, it keeps a record. In very layman's terms, if I tell you, this is a feature, let's say in our accounting system, which keeps a record as to when was a transaction done, who did the transaction, at what point of time was it done, which system was used to make the transaction. If any changes are made to the transaction, that would also be recorded. So these logs now, probably you as an auditor can see these logs to see if they have made any manipulation in the transactions or not. Okay, in India also what used to happen, a lot of backdate entries would be made. In India what happens is, many companies would determine, see, oh, this is a profit they are getting, and then when they have to pay a lot of taxes, they would book in some fake expenses. And also if fake expenses are booked later on, you can see the audit trail and you get to know that this never happened in the month of April. The entry was only made after the financial year end to manage the profits. So audit trails are what? It's what is the concept? It's basically the documented flow of transaction used to investigate its translation into financial statements. So right from the source, from where is the transaction entered, who entered, at what point of time he entered, using which system he entered, everything would be recorded. It records system and the user activity. Okay, so just remember, guys, audit trails are logs. They are logs. Okay, now what is the purpose or benefit of these audit trails, guys? Audit trails helps in reduction of fraud, errors, unauthorized use. It enhances internal controls. Now if everyone knows that all their activities are being logged, they can't do backdate entries, they can't manipulate the transactions. And also this is the purpose and benefit. But what are the challenges, guys? It's not easy to implement audit trails. Okay, the government has mandated it, but it is costly. It might be a costly thing. So it says, what are the challenges of audit trails? It's cost implications. And guys, audit trails will again keep on, all the transactions which is done, the audit trail logs will be there. Again, you need more storage space. You have to handle that volume of data. So need for automated tools for analysis to handle large volumes of data. So if you want to have a look at the audit trails also, guys, it's the data is going to be huge. Okay, so you need to have some specific softwares also to analyze those data. It can't be done manually, right? So these are the two challenges of audit trails. Okay, again, a new concept which was introduced, but then it was there in detail in your EIS subject, which was there in the old course, no longer there in the new course. Okay, all right. So with this, guys, finally, we are done with chapter number 3. We have covered all the topics in great level of detail.